there's a very significant increased geopolitical risk. It can come from any number of places.
The real risk is probably geopolitical.
You have more geopolitical risk, so that could then bring prices under pressure.
There are issues that, for sure, they haven't been priced in the market.
Whether it's a geopolitical issue, whether it's a policy mistake, the risk of this thing going the wrong way is there and will continue to be there into the foreseeable future.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
Live from Davos, Switzerland, for our audience worldwide at the Economic Forum on day 3. This is Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro, together this week with Annmarie Hordern. Your equity market trying to bounce back. 2 days of losses on the S&P 500. We've been talking all week about the broken model in Europe. Well, Emmanuel Macron, the French president, had something to say about that in the last 24 hours. Bramo advocating for what he calls a sovereign Europe.
Less regulation, more high-paying jobs, investing more in infrastructure, investing more in technology, to basically doing everything that we were talking about, you in particular, that needs to happen in Europe. You can feel the urgency to create national security through some of these plans at a meeting that is not as committed to globalization.
It's as if his speechwriter watched Bloomberg Surveillance on Tuesday morning when we were talking about this. The dependence on Russia for energy, broken. The dependence on growth from China, challenge. The dependence on the United States for defense, cracking. These are big, big issues for us this year, Annmarie.
Yeah, absolutely. Macron said that 2024, 2025 is all going to be about how Europe can be more sovereign, whether it's AI, whether it's investment. I think it was a little bit of a dig as well for the Inflation Reduction Act. You know, the cloud that is hanging over this Davos is Trump 2.0. But the Biden administration, when it comes to some economic policies, have also irked some European leaders.
Lots of coverage on this still to come. Let's go to the price action, Bramo, just to start. Equities trying to bounce back on the S&P 500 up by 0.2%. After 2 days of losses, you had day 1 of the trading week with Governor Waller pushing back against rate cut expectations. And day 2, really those comments reinforced, at least by the economic data. Retail sales are a whole lot hotter than expected.
Which really gives credence, frankly, to what we're feeling here at Davos. Every business leader, one after another, has come out and said things are better than expected. Is this going to be a rebound year? It is so different than some of the angst that we've been hearing that would call for 6 rate cuts this year. So to me, that's really been a massive takeaway.
Equity futures positive by 0.2%. Just to check in on the bond market, yields have been pushing a little bit higher on a 2-year, on a 10-year over the last couple of days. The 10-year yield at the moment in the Treasury market looks like this. The 10-year is at about 4.08%. The 2-year, Bramo, at about 4.32.
We have another incredible lineup today. I really am looking forward to all of our guests, including Jim Fitterling, Chair and CEO of Dow Incorporated, on the broader view of the industrial sector globally. Becky Frankiewicz, Chief Commercial Officer of Manpowergroup, massive personnel placement group. Joe Taylor, CEO of the Ontario's Teachers Pension Plan. And of course, we cannot forget someone sitting next to us, Adam Posen, who is president of the Peterson Institute. And in just a moment, we're going to be speaking with him as well, which is going to be a fascinating
Looking forward to getting Adam's views on this. A big topic, a conversation in Davos, Switzerland all week. The pushback against the rate cuts priced into this market.
The market might be a little bit ahead of itself in terms of rate cuts this year. I have no doubt that we'll get to rate cuts at some point.
The markets have now priced in what I think is probably excessive interest rate cuts in the U.S.
We still see rate cuts, and we are actually predicting that they start sooner rather than later.
The market is being aggressive on rate cuts, all right? And I believe that the Fed is going to take its time.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening.
I think markets are being a little exuberant, expecting as many rate cuts as they've put in.
The market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all.
Joining us now to weigh in, Adam Posen, president of the Peterson Institute for International Economics. Adam, good afternoon.
Thanks for having me,
It's
Jonathan.
the Pushback World Economic Forum. Did you get a sense of that as well?
Yeah, and I mean, the central bankers have been pretty clear. We just did a short rerun of the second half of last year. Central bankers kept telling you, we're going to 5+, and everybody's like, no, they won't do it. Now we're staying at 5+. No, they're not going to do it. And it's just the cycle sped up this time. I mean, at some point, you should believe with them when they talk.
And they're talking right now. They're basically saying we're not cutting in March. Do you have a sense of confidence, though, about the disinflationary trends that have emerged over the last 12 months? Are they durable? Do you think that continues?
I think there's good reason for it. I think you mentioned the retail sales data, the recent U.S. data. There's a little bit of better news in the U.K., which I think is going to be an illusion. There's decent news in the ECB world. Look, it's going to be a short-term thing. By the end of the year, they will start cutting. They will make the direction clear. People who want to trade day to day obviously get that a little frustrated, but I think it is right to say fewer cuts later this year.
To build, though, on what John is talking about, is the immaculate disinflation overplayed? We're talking about unexpected strength.
Yeah.
Forget rate cuts. Are we even going to see the disinflation that we're expecting? Are we going to see another resurgence, especially given what's happening in the Middle East, especially because of some of these trade fissures that keep emerging?
It's a good question, Lisa. I tend to downplay from an economic as opposed to a geopolitical view the impact of these things in the Middle East. The general history going back to 9/11 has been that the economic impact of these kinds of disruptions is not very long-lasting. And if they are, it'll be treated much the same way COVID in retrospect was treated. You know, this is something that goes up, it comes down, nobody should panic in the rich world. I do think there are more risks to the upside on inflation. I'm not a big believer in recession risks for the U.S. And so that's why they're taking out a little bit of insurance. But I think if you emphasize the word landing more than soft, I think we've achieved it.
I asked somebody last night what you think is the topic that isn't being discussed at Davos that should be. And he said, without question, fiscal. The deficits that are increasing, they're increasing globally. People aren't talking about it anymore. For a hot second, they thought it was a problem, and then the Treasury market kind of evened out. Is that going to be more of a disruptive force in the next 12 months?
Unquestionably, and I think not just the next 12 months. I mean, the next 12 months are basically shot because of the number of elections we have around the world, as well as the pressing green needs, pressing defense needs. It's more, do we deal with the fact that likely for the next 4 or 5 years, none of the high-income economies are going to be raising taxes, but they're going to be sustaining increased defense spending, sustaining increased green investment, possibly sustaining some not-so-great industrial policies. And that's where I've been trying to sell at Davos in my role, is that that's where the international cooperation and understanding needs to come in, that if the G7 plus China are all on a fiscal expansion path, how do we manage it? Because that's higher interest rates sucking capital out of the developing world.
How much higher? Can you just give a sense?
In my view, as Larry Summers has said, we're kind of running the peace dividend of the early 90s in reverse. So back of the envelope, I think the capital costs are going to be up 0.7% on the 10-year. I don't mean what today's level is, but I mean like for like. If you compare the sort of low inflation 10-year of 2019 with the low inflation 10-year later this year, it's going to be about 7/10 higher.
You mentioned elections coming up, the most important particularly being in the United States. Do you see deficit management changing, whether or not we get another 4 years of Joe Biden or it does go back to Donald Trump?
You know, everything changes if Trump wins, in mostly for bad ways, speaking as an economist. I think the reality is, as you've been covering, the American electorate is going to be more strategic. If Trump wins, the Democrats will likely hold the House. If Biden wins, the Republicans will likely hold the Senate. And so it's going to be about this sort of stealth fiscal policy, that not by conspiracy, but I mean things like we've had this huge shortfall in tax revenue this year that nobody talked about. Things like the industrial policy hasn't been spent yet, but as these machines and plants come online, more will get spent. So it's going to be a lot of fiscal, not by legislative means. I obviously think it'll be a little more compromising and therefore more stability under Biden than under Trump. Final thing, I know you know this, but just to remind your global viewers, the tax cuts from 2017 expire in the first quarter of 2025, whether Trump's there or not. And so the question is, do you have a sudden jump up in taxes, which wouldn't be a bad thing, but you probably won't. So the question is what deal you get then.
Adam, you did say that you think that things would be mostly worse if Trump did win another term. 74 million people in 2020 clearly didn't feel that way. You've talked about trade this week, and I think we should explore that just a little bit more. The prospect of higher tariffs. The former president has put out somewhat of a plan.
Right.
These things can change. The campaign is long. You've given thoughts to what that plan could look like and the consequences it could have. Can you walk us through it?
Yeah, thank you for asking that, Jonathan. I mean, I think we back, Peterson Institute, my colleagues and I back in 2016, took Trump seriously in the sense of we said he stated these things, this is what he's going to do, let's model what happens to the economy. And we're undertaking that same exercise now. We're taking literally, if he puts up a 10% tariff on everything, and then you have to figure out what that means. Does that mean you reduce tariffs on China to 10%? No. But anyway, you come up with a variation of that. And it's a tax increase. I mean, however you want to say it, it's a tax increase on all consumers in the U.S. And it probably increases inflation rate roughly 1.5 points in a year. Does it keep causing inflation? Probably not at the same rate, but you start having shortages and reallocations and, versions of what we've seen during COVID, because you're also cutting off migration, you're also cutting off foreign direct investment. And so like Britain under Brexit, you suddenly have shortages in this, that, or the other sector, and it's hard to reallocate. Companies, it's more expensive for them to get inputs. Anyway, so it's for real. Lighthizer has written about this in the Wall Street Journal. He has the power to do it, at least temporarily, until Congress reviews it. And it would be basically a negative supply shock. You would see higher inflation, lower productivity, lower growth.
When you talk to international representatives, which is really what Davos is about, how are they preparing for it, particularly in China?
This is the big question. In my conversations with non-U.S. officials, it's always about what will you stand up for? You mentioned earlier President Macron's speech, and talking about sovereign Europe. And, at a minimum, you would like the EU to stand up for the rules-based international economic system for trade. But there seems to be a lot of resignation, unfortunately, among the officials I'm talking to, including Chinese, that the U.S. does what it does. And some people say it's justified, some people say it isn't justified, most people say it doesn't matter whether it's justified or not. And so the question is, what does the rest of the world play out? And I think the hope for all of us is that the non-China and the U.S., non-U.S. rest of the world creates a safe space for trade and investment, and China and U.S. don't begrudge the rest of the world that.
Just to round things out, do you get the sense that this is the direction of travel, regardless of who wins the White House later this year?
I'm hopeful not. There's no question that there's been great continuity, particularly with respect to China, but generally on trade and some foreign investment between Biden and Trump. I think they have different motivations to some degree. I think the Biden team has been a little better about doing it through law and not through arbitrary sort of exemptions. But fundamentally, there hasn't been that much difference. I am hopeful that if the Biden people get reelected on this issue, people like Secretary Yellen, Secretary Raimondo, NEC Director Brainerd take the lead, and we at least don't get further down this road. That didn't
happen this time around.
No, it did not.
There was a conversation at one point. In fact, I remember us catching up and talking about it. We were talking about maybe reducing the tariffs that the former president had put on China. It didn't happen. Why would that change anytime soon?
As I said, I've scaled back my optimism. I don't think they're going to reverse it. But the idea that they're not going to go further and impose a tax, or not going to go further and escalate the conflict.
And thoughtful stuff, as always. Big year ahead. Just massive. It's good to see you.
Good to see you guys.
In Davos, Switzerland. Adam Posen of the Peterson Institute. Elisa, it's good that we're shifting away from the theatre, the drama of the election campaign. There's going to be plenty of theatre, plenty of drama in the year to come. But we need to talk about policy. And the prospect of policy changing, regardless of who takes over the White House in the next 12 months or so, what it means for this economy and ultimately what it means for this market.
You ask why hasn't it changed, right? Why has it not changed more under an administration that gave lip service to ratcheting it back? And the reason why is because it's popular. And that is really the underlying consideration here, that it wouldn't be popular to take a softer line on China before the election. So that, I think, is that resignation that Adam Posen was talking about in the rest of the world.
As well as the Treasury Secretary coming out with a speech and saying, we, of course, want to lower inflation, but we will not do anything economically if it hinders national security concerns. And in that sense, the national security team, Jake Sullivan, won when it came to things like China and tariffs.
And keeps winning, apparently, on that issue. Coming up on the programme, that conversation will continue in the next hour. The brilliant Nobel laureate, Michael Spence. Mike Spence coming up in about 60 minutes' time. Do not miss that conversation. Equities, after pulling back for 2 consecutive trading days on the S&P 500, attempting to bounce on the S&P up by 1/3 of 1%. From Davos, Switzerland, good afternoon.
the investment bank has been extraordinarily successful. We have had a strategy over a number of years to do investment banking and to do it well. And we are the leading investment bank domiciled outside the United States. People are looking for a partner and a counterpart who's not just a US bank. And if they had to pick one, they tend to pick British banks, and we're a strong British bank.
Have a conversation with you.
That's the pitch. CS Venkatakrishnan, the Barclays CEO, alongside Lisa Abramowicz and Annmarie Hordern. I'm Jonathan Ferro. Bramo, I think you've drawn the distinction between the thinkers and the doers, and at risk of offending people, there is a clear difference between the thinkers and the doers in Davos, Switzerland this week.
It seems like the thinkers are gloomy and the doers are optimistic. And that has been, frankly, the incredible takeaway that I've gotten. The people who actually run businesses see incredible optimism ahead. And the people who think about all the potential things that can go wrong are very depressed. And that, frankly, is the divergence.
At risk of offending people, I'm sure we just did. But Lisa, I wonder, is that because they've got a story to sell? The doers, they've got a product, a service, something to sell? Or do you reckon they actually see something on the ground that gives them that reason for optimism?
I mean, call me naive, but I believe them because it's been consistent and it's been with some specific examples of places that they're seeing it. And frankly, we're seeing that in consumer spending. Even the Beige Book, which I know is sacrilege to mention at a time like this, really showed an increase in appetite in consumer spending.
Is anyone reading the Beige Book?
I read parts of it.
Maybe a little bit. OK, you can share those parts with us.
It's OK, we don't have to.
Equities look like this on the S&P 500. 2 days of losses, trying to replace that with a day of gains. It's been a soft week. Over the last 2 days, only down by something like 1 full percentage point, not even. We bounced back by 0.25%. Yields come in by a couple of basis points. At least I think we can call it 4.1%. But when you put together the comments from Governor Waller and a strong retail sales story we saw just yesterday, it's quite a powerful pushback against those big, lofty rate cut expectations that could begin as soon as March.
It is shocking to me that we're still pricing a more than 50% chance of a rate cut in March, given some of the data that we've gotten and given the pushback that we've gotten. So I'm just wondering what other people are seeing that everyone here who's leading businesses is not.
We're going to ask Jim Fitterling, the Chair and CEO of Dow, on Fed policy. Jim, we're not. Good afternoon. Good to see you. Just in case you thought you had to establish an opinion on that, it's good to see you as well. I actually want to pick up on some previous comments that you had on the global economy, I think, at the end of the third quarter. I think you described things as a challenging macro environment. Has your assessment shifted in the last 3 months?
Yeah, I'd say it was a mixed economy in 2023. I mean, you saw pockets of strength. You saw things like the automotive sector, especially driven by EVs and the growth in EVs. We saw weakness, obviously, at the beginning of the year in consumer electronics, durable goods, obviously things that are related to housing and the slowdown in the housing markets because of interest rates. But the consumer disposable business was good, so the day-to-day buying food at the grocery store, health, those areas were relatively strong. I'd say as the year unfolded, we also saw some positive things from an operational standpoint, supply chains coming more into line. In our industry, we'd been working through some destocking through 2023. And as the consumer demand stayed strong and the retailers got inventories back under control, you would start to see kind of a more normal cadence to things toward the end of the year. So I'm optimistic, at least from a perspective of if we have seen rates moderate and we are going to see a decrease, then I think you're going to see some potential to build some momentum into the housing sector by the end of the year. And then that carries, obviously, an awful lot of volume, both here. And look, that's the same thing we've got in China. China's housing sector has been slow, and Europe's been slow as well.
Well, let's just go there, because you're talking about the consumer spending and you're talking about Fed policy. This is all the U.S. How much are you actually seeing shoots of optimism, green shoots, whatever you want to call it, over in China as well, given some of the real pessimism we've heard here?
Well, China, we have a footprint in China, and we have, obviously, business that we supply from the U.S. from an export standpoint. So the U.S. is very competitive. And if you think about our global footprint, about 85% of our global footprint is in low-cost locations like Canada, the United States, Argentina, the Middle East. So that's been positive. And as the export markets and supply chains have lined out, we've seen growth in China. And China GDP at a little bit above 5% is not a negative number. I mean, that's a real positive sign. So we've seen that. I think what we would like to see is that the Chinese economy, the consumer-driven part of the Chinese economy has been held back a little bit by the construction markets. And that'll be another leg up if we can start to see that in 2024.
So Davos is typically this haven of talk about sustainability and global warming and all sorts of things. And here you are producing a lot of the chemicals that goes in plastics and all of the other things that are kind of demonized by a lot of people here. Is it awkward for you this year?
It's not awkward. I think people misunderstand what the industry is trying to do. We're a first mover in advancing sustainability, and we're also doing it in a way that creates long-term shareholder value. Just before the end of the year, we announced FID on the world's first net zero ethylene and plastics production facility in Alberta, Canada. And that will feature, among other things, using hydrogen in the furnaces to make the plastics versus natural gas. And so that's how we make sure that we have zero Scope 1 and 2 emissions. It's a little bit more expensive to do it, but with the investment tax credits and with a market price on carbon that Canada has, that allows us to be able to recoup that and to deliver an investment that has a really good return on capital for our investors. By the same token, IRA in the United States has really advanced things. We're a participant in the Advanced Reactor Demonstration Program with DOE. So we have a project in our Seadrift, Texas facility to build the first small modular nuclear reactor there with X Energy. And that is on the basis of a high temperature gas reactor, which produces both electricity and steam. And for a big industrial process, we need as much steam as we do electricity. But I can take that site essentially to net zero through that investment. And gives that, a power system that'll be in place for decades there and really moves us forward. So Canada, by the time we're done with the Canadian project, 25% of our global ethylene will be zero Scope 1 and 2 emissions. We have a complete plan by 2050 to take our entire fleet to zero Scope 1 and 2 emissions, all on the basis of technology investments, not through offsets.
You're getting $25 million from the Department of Energy because of that IRA. Do you expect that money to dry up if we were to see a change in administration?
Well, I think one of the reasons the Department of Energy supports us is we're trying to help mitigate the risk and trying to show how we can deliver these units at a repeatable cost that's affordable for an investor. So you need an industrial company that has good project management capabilities like ours that can deliver a mega project at a low cost. We hear a lot of times about big nuclear projects and cost overruns. I'm not in a business where I can pass all that cost down the chain to the consumer. I've got to be competitive. And so what we're trying to do is work with X Energy and DOE to say, here's our target for the cost of this energy, the cost of these capital projects. And if we can execute that, then I think you're going to see other industrial players follow. And at that point, you won't need to subsidize every further investment that's made.
Music to people's ears, I think, worldwide, who are possibly nervous, Bramo, about paying more taxes so they can subsidize more of these things.
Well, this is exactly the fear. And this is actually what I keep hearing is what's necessary to kind of make things economic, to drive things in the right direction.
Yep.
Kind of disparate feelings. But was it a policy necessity to pump 13 million barrels a day of oil in the U.S., so it's not happening as quickly as maybe some people would like.
Secretary Kerry was brutally honest and transparent about that in a way that I had not heard from this administration for the last 12 months, who had basically ignored the fact that U.S. crude production had gone through 13 million barrels a day. Jim, going to leave it there. It's good to see you.
Good to see you.
Thanks for being with us. We appreciate it. Jim Fitterling there of Dow. The Inflation Reduction Act keeps coming up, doesn't it, AMH?
What's so surprising about it is that all this money is being flooded into the market, and states and companies like Jim's is going to red states. This money is going to places like Texas. It's going to places like Georgia. It's going to places like Florida. So potentially can help Republicans, even though this was a huge legacy of the Biden administration.
It's amazing, isn't it? Just amazing. Coming up on the programme, really strong 30 minutes still to come. We'll catch up with Becky Frankiewicz of Manpowergroup, and then we'll catch up with Joe Taylor from the Ontario Teachers Pension Plan. All of that still to come, live from Davos, Switzerland, on day 3. This is Bloomberg. Let's check in on the price action on the S&P 500, trying to bounce here after 2 days of losses. Equities shaping up as follows. On the S&P, the Nasdaq, the Russell, the small caps up by about 0.5%, the Nasdaq up by 0.5%, the S&P up by 1/3. We've had 2 days of losses, but I would call them muted losses, you know, Lisa. We've seen a big readjustment. I say big. We can frame big in just a moment in the bond market, but ultimately we're down over the last couple of days by not even 1/4 percentage point.
I actually was thinking a lot about this last night because, you know, that's what I do. But I'm curious about how much you could see the bond market sell off and the stock market hang in there. If you're talking about a soft landing, people may be overpricing the potential for rate cuts because of the strength that you're seeing in a lot of the economic data. But that ultimately should be more supportive for risk assets and equities.
Yesterday was a fantastic example of that, both for the data and for the bond market. So yields shift higher. We can check in bonds right now, 2-year, 10-year, 30-year. New 2-year at about 430 something. Yields up big time yesterday morning. Off what? Lisa, better data. Retail sales look good.
They came out better than expected, followed up by a beige book that really indicated maybe some cooling in the labor market, but otherwise consumers continuing to spend. And here's the issue. Is this inflationary, first of all, which we don't really know yet? A lot of people say it might not be as inflationary. But second of all, can you get a move in the bond market like this and not see any influence on stocks because people have already realized the world can go on at rates at these levels?
So the bond market move yesterday made sense. I think the move in the FX market is far more difficult, complicated, complex. Look at the euro. Now, this is what the euro is stuck between right now. President Lagarde saying we're not going to cut anytime soon. Yet the data in Europe is terrible, yes. And the data in America is good. And there's some real tension between those two things. Relatively speaking, the US economy looks a whole lot better than what's taking place here in Europe.
Which is the reason why we're still around 109 and probably will stay there because nobody can really come up with a definitive solution to that tension.
Just that tension in that rope, that tug of war.
I mean, especially with UK inflation heading up just a little bit. What do you do with this? I don't really know. But I do know that the ECB is trying to walk back some of those rate cuts that other people are saying you're going to have to actually do.
Just like the Federal Reserve. Just like the Federal Reserve. Under surveillance this morning, your top stories. Escalating tensions in the Middle East. The US launching another round of strikes on Yemen's Houthi rebels, targeting 14 missiles, which Central Command called a, quote, imminent threat to merchant vessels in the region. Hours later, Pakistan launching targeted strikes against militant targets in Iran, responding to similar attacks from Tehran yesterday. AMH, that sounds like an escalation.
It's an absolute escalation, and it's on top of minds of individuals here because this is the main artery of global trade going through the Red Sea, the Gulf of Aden, and now they're having to spend a lot more time, a lot more money going around Africa. We need to see exactly what the U.S. struck, though. Is this another degradation of what the Houthis may be able to use to go after these merchant vessels? But at some point, are they going to ratchet it up where it's a big enough message that the Houthis actually stop?
All I can say is the fact that the Iranian foreign minister is here and the president of Israel is here. I'm wondering what conversations are happening behind the scenes to try to resolve this, if at all. But it seems like a momentary pause where some meeting of minds maybe can happen. I don't know. It's just an interesting sort of juxtaposition.
Well, I could tell you this. Those two individuals will not be meeting together anywhere.
I assume so.
Potentially they'll walk past each other. But, you know, there's other players here. The Saudis are here. The Qataris here. Other individuals who can broker potentially some kind of negotiation.
A one to watch a little bit later on this afternoon in Davos, Switzerland. Here's your next story. It's Apple is selling versions of its smartwatch without a functioning blood oxygen feature after a setback in its patent dispute with Massimo. It's the latest in a string of challenges for the tech giant. Netflix also announcing it will not launch an app for the company's new Vision Pro headset, which goes on sale next month. It has not been a great start to the year for what was, I think, briefly the world's largest company, because did Microsoft take over?
Yeah,
briefly?
Microsoft took over.
I'm struggling to keep up with where they both are, but yeah, Apple, double downgrade to start the year.
Right.
Massive run up in 2023, despite some pretty soft, weak numbers coming off the iPhone. Stock was up by something like 48%. That's the standout for me in earnings season. Early February, Apple.
Especially given the fact that we've heard mixed things with the potential of some sort of plateauing in the smartphone market after declining. All I can say is you were skeptical. You thought that it was a marketing pitch, John. You thought they were just trying to get you to buy an Apple Watch ahead of the holidays and it was going to come back online right after, but it actually was not. And that, I think, is my big takeaway.
Well, no, I was just saying that if you wanted the blood oxygen feature, that buying it before Christmas, everyone was rushing there. And did they do that? I guess we'll find out when we get numbers.
If you want the blood oxygen feature, just buy it here in Europe now before you go back to the U.S.
Or go to Best Buy, right?
Because it's still available in Europe and other countries.
So there's the Apple pitch.
Pro tip.
There
yeah,
you go.
exactly.
There's the Apple pitch.
Go to Europe.
Let's finish on this. Mixed results in luxury retail. Shares of Richemont rising rising after posting higher-than-expected sales during the holiday season, benefiting from strong demand for its jewellery out of China and the United States. Meanwhile, watches of Switzerland slumping after the UK's top seller of Rolex cut its sales and growth forecast, blaming volatile demand and a shift in luxury spending habits. So, Bramo, a little bit later in the programme, we'll catch up with a massive person who focuses on tourism in China. I think that's the interview to watch a little bit later to gauge what's going on in the world's second largest economy. I
could not agree more. The CEO of Trip.com at a time where it does seem like there is real weakness. I mean, we keep seeing it again and again, and it's not clear what levers the Chinese authorities can use or are willing to use. But at the same time, they have a lot of money that they haven't spent yet. And luxury isn't doing that bad. I mean, maybe they're not all buying luxury watches from Switzerland, but it's not as if luxury hasn't been doing well. That
conversation a little bit later this afternoon. Joining us now on the potential weakness that's emerging in this labour market, Becky Frankiewicz, the Chief Commercial Officer at Manpowergroup. Becky, good afternoon.
Good afternoon.
It's good to see you. We saw in the latest labour market report, just going back over the last 12 months, just temporary workers. It's a real weakness that's starting to emerge there. Do you see the same thing in the business?
Yes, and so temporary workers is usually a good leading indicator for a slowdown in the economy. It hits about 6 weeks before the rest of the economy, where employers are thinking, I now need to hold on to my permanent employees and I let my temporary workers go. So we've seen month-over-month reduction in temp worker. However, defying history, we're still seeing resilience in the U.S. labor market, truly driven by 3 areas. Lots of concentration. Jobs that help people, registered nurses, #1 job in demand in the U.S., jobs that transform businesses, software developers, application developers, and then finally, a newcomer, jobs that provide affordable experiences. So we saw Pizza Hut and Walmart come in the top 25 employers for the first time in months.
Affordable experiences, fast food workers, that's sort of my translation in terms of what that means. Are these, and I hate to ask this, but are these the jobs that you want to see being created that will generate the kind of strength in the economy? Or are these the jobs at underemployed types of services that have had a real dearth of employees for a long time?
Yeah, so during the pandemic, the sector lost, fast food specifically, lost a tremendous amount of employees. And so we need employment across the economy. We need on-roads into employment in every sector. And so, yes, fast food is one of those sectors that provide an on-ramp for people to get better jobs. But we saw a real departure during the pandemic, and now people are starting to come back. Hospitality and leisure is another, again, affordable hospitality and leisure is another place we're seeing tremendous growth.
You know, you talked about software developers. There was news out this morning that Google, after cutting a lot of jobs, plans to cut more jobs, but around the edges so they can hire other people. Are there certain sectors that you're seeing market weakness that you think could be, you know, sort of leading indicators of what's to come, or are you just not seeing that anywhere?
Yes, let's talk about tech for a moment. So when the big tech headlines came out of all the layoffs, tech unemployment was 2.5%. Guess what? All of those people were scooped up in small and medium tech companies and companies like Walmart, who happens to be the top hirer for AI skills, DoorDash, #2 hirer for AI skills. So every company is a tech company now. So some of the headlines were misleading. In terms of weakness, overall, tech has slowed, but it's still incredibly strong and one of the fastest driving sectors for growth in the U.S. economy.
AI has been a huge focus of this Davos. What are you hearing from people and how much it can disrupt the labor market?
Yeah, so AI, we've made AI very big here, so I'm happy to have the conversation on AI. The great thing about AI is we've seen a structural change in the labor market in terms of population growth, you know, aging, people opting out, retiring. We need AI to come in and take some of the roles so that we have enough people to fuel the global economy. So I think AI is good. It is going to disrupt some roles, but just like history, all of our research shows AI will create net positive roles for the future. And so we're quite confident. The other thing I'll say about AI is it's the first technology-driven transformation that doesn't require technology skills. Very accessible. So you can be a prompt engineer without any coding experience at all.
Mike Spence, Nobel laureate, joining us in about 22 minutes on AI. A question I'm going to ask him, I want to share with you as well, just to get your feel for it, your reaction. Exactly to what Annmarie's talking about. Globalization decimated manufacturing bases in certain countries. There is a fear that perhaps artificial intelligence can do the same thing, but to services. Do you not share that fear then?
Yeah, it is absolutely going to have a disproportionate impact on services and entry-level skills, which is something we haven't had a lot of talk about here in the forum. But what I would say, it's also going to create new opportunities and new skills and new jobs. The challenge of leadership now is we need to humanize work while we're digitizing work. And that will be the defining challenge for our generation.
It felt like for a moment it was a new era of labour market power. The leverage had shifted coming out of the pandemic. Has the pendulum swung back?
Yeah, so great. I'm asked that question by CEOs across the world, and so that's a hot take on a question. I would say we're seeing balance now. So during the pandemic, the power shifted to the employee, and now as labor markets continue to be tight, they still have power, but as demand reduces, we're seeing a balance. And so maybe for the first time in history, actually, we're seeing a new compact between employer and employee where balance is at the center.
Do you think that as a result, real wages will continue to rise going forward?
Yeah, I hope so. I hope so, because back to your fast food question, we saw real wage growth rise in the U.S. for the first time in decades at a minimum. And I hope that we see, as we have higher order skills, we reward that with higher wages, whether it's at the fast food line, because think about in fast food, if you digitize it, you have to have the skill to actually run the digitized capability. And so I think we'll see wage growth as a result.
I love speaking with you because we get this economic data and we always wonder, what are we missing? What's fuzzy here? What's inaccurate? And you're on the ground. What's your leading indicator to understand what we're missing, whether perhaps this is set to turn or it's one way or the other, either up or down?
Yeah, so we do see real-time demands. That's the difference. When BLS reports it's a month in the rearview mirror, we see in real time. We are starting to see a bit of softening in demand, meaning jobs posted. We're seeing that across the economy, even in registered nurses, still number one, but softening. And so I think the first half of the year for the U.S. economy is probably going to be more of the same that we saw in the end of the year, a cooling across the labor market.
So you still think there's going to be a lot of demand to go out there for those jobs?
I think there'll be continued demand. I think it will be at a lower pace than we saw, at the beginning of 2023.
Just want to finish on this, just to lean on your experience at PepsiCo over the last decade plus as well. You've got a decent read on inflation, input costs, particularly in your current position too. Was that moment really just transitory, this T word that Lisa gets frustrated with because it's coming back up again? It was poison maybe 12 months ago. Is this moment just a transitory phenomenon, or is there something sticky about it?
Well, I think it's both are true. I think we're going to have a little bit stick and a little bit that's going to go away. And the stick, though, I hope leads us to better jobs, better wages, and a better overall economy.
Becky, this was super smart. Thank you. Becky Frankiewicz there of Manpowergroup, one of the biggest staffing firms on the planet, with a really solid read into the labour market.
And fascinating, kind of confirming what we're seeing, which is the JOLTS data, which we always say, how accurate is it? The job posting, that actually is accurate in terms of some of those postings coming in. And on the flip side, real strength, the tech hiring part. To me, I love that she said that, the idea that Walmart was the #1 hire of some of these tech officials. It just highlights why some of these layoffs aren't affecting the economy, because people are snapped up like that.
So introduce the election campaigns that are going to take place throughout this year. AMH, is the calendar on the president's side? When you start to hear things like maybe a little bit of weakening in the labour market, that's not going to be good news for the White House and this president.
No, absolutely not, because that's the one thing they're holding on to, that the labour market has been very strong despite higher inflation. So inflation doesn't come down quick enough, and then you see a weaker labour market. What do they have to hold on, and what's their economic message they're going to sell, which the president, by the way, is going to be touting Bidenomics today in North Carolina. Let's see if it lands.
Well, all I can say is that there's a real tension here between both of these narratives that we've been talking about throughout the first hour, which is on one hand rate cuts that would come with real softness and weakening, and on the other a strong labor market. The strong labor market is one of the reasons why people see a soft landing. Are we even landing? And I ask this question seriously.
Pipe dream, according to Rogoff.
No, I mean, seriously, what is the landing going to look like? And is that really something that Joe Biden's going to be comfortable with in terms of capital creation?
I'm not going to make a call on that. Do you remember 12 months ago?
Yes.
Do you remember? It was hard landing, then it was no landing, then it was hard landing, soft landing. We flipped back and forth about 5 different times in the last 12 months.
Yeah, but this feels stickier, not to use that word. But come on, am I wrong? Have you not heard everyone use the word soft landing?
Yes,
and they're from every walk of life.
Well, Adam Posen said he's going to call it a landing. He's going to get rid of the word soft.
The focus is on the landing.
Yes.
In fact, Brian Moynihan, Bank of America, so Mike Gapin put out the note to start the year. It is the year of the landing. I'm sure everyone's just going nuts at home now. Shut up. OK. Coming up on the programme, Joe Taylor, CEO of the Ontario Teachers' Pension Plan, not at the landing this year, about how he's investing for people who need to retire. Joe Taylor coming up very shortly. Snapshot of the market. This is what it looks like right now after 2 days of losses on the S&P 500. Equities pushing higher. In the bond market, yields coming lower. Kind of the last couple of days in reverse. From Davos, Switzerland, at the World Economic Forum on day 3, this is Bloomberg Surveillance.
I will campaign for President Biden. I will certainly, because the stakes could not be higher for our country, for the world. He stood up for American values, global values, universal values, for America's obligations with respect to Ukraine, the Middle East, and elsewhere.
John Kerry on form yesterday, the US Special Presidential Envoy for Climate. Secretary Kerry, I have to say, was blunt. I appreciate this transparency. He's got his views. We asked him about the 13 million plus barrels a day of crude that's produced in the United States of America. Didn't shy away from it. In fact, Annmarie, he said it was necessary.
Yeah, Lisa says a policy failure or policy success, given what they're trying to do on climate change. And he talked about the necessity of it when you're waging a war on Russia and there's also disruptions in the Middle East.
I say it was refreshing, Lisa, because we've barely heard that from this administration at all on fossil fuels.
We haven't heard anything, really. And that's really, I think, the key. And really, at this point, the fact that that has become essentially the de facto policy to pump as much oil as you possibly can has been one of the main drivers of oil prices going lower. What did he say, John Kerry? That if we didn't have that, we'd have social unrest, and so it was a necessity?
Yeah.
I mean, that's pretty strong wording.
In the United States, specifically, the fact we're in the 70s, that 13 million barrels a day in America, if you did not have that, I doubt crude's in the 70s right now. That's for sure. Snapshot of the markets looks like this right now on the S&P 500. It's a little bounce, a bounce back from 2 days of losses. We're higher by about 1/3 of 1% on the S&P. The absolute perfect guest to catch up with on financial markets and investment trends. A man who I've been fortunate to spend some time with over the last couple of weeks is Joe Taylor, the CEO of the Ontario Teachers Pension Plan. Good afternoon, Joe.
Thank you.
It's good to see you. Fantastic to catch up. I think for people who aren't familiar with what you do, you have a pension firm that essentially has to cater to one unique pension profile, retirement profile, and one career. Can you walk us through how complex that actually is?
Well, in some ways it's not complicated because we have one community. So some of our Canadian peers and other peers have multiple stakeholders, so we're lucky from that perspective. Our members, so we have about 300,000 teachers, about half are working, half are retired. And certainly our retired members have strong views about what they'd like us to invest in. The challenges for our dynamic is we have a group of members who actually live a long time. They work for a shorter period because often they do something before they become a teacher. And we just have to really look a long way out into the future to actually make sure the plan is funded and our liabilities are covered.
So inflation doesn't help, because I understand things are indexed to inflation.
Fully indexed. So last year it was 6.3%, this year it's 5%. And that does introduce a challenging dynamic where inflation is a pretty challenging instrument for us.
Does it change the way you have to invest?
I think, we've learnt the hard way over 34 years that you stay your course and actually plan for longer term. So our dynamic is really to look for a return of about 4% real. But obviously when real is 5, 6, 7%, that just makes the issue much more challenging.
Well, this is where I was going to go. At the time where there was basically zero rates for a long time, we were one of the pioneers in creating your own internal private equity-like unit where you invested directly in companies. Are you moving away from that now that real yields are getting closer to what you actually need?
Well, look, that's a great question. We've been investing in private equity for over 25 years. We've had about a 20% return net of all fees and carry paid to third parties, so it's served us really well to date. So there's the question, what can we do going forward? I would say if I picked out private equity for one thing at the moment, it's lack of liquidity. So our portfolio is not very liquid, and we really have to decide as a long-term pension plan whether we were really willing to sell assets at a discount to find that liquidity just at the moment.
So what's the answer?
I think for us the answer is to invest carefully, actually look at businesses that we think are better than what's already in the portfolio, and actually try to find solutions which aren't predicated on bank debt. So sometimes we can buy companies without any debt at all and leverage it later, and we have the balance sheet to be able to do that.
We spent some time earlier in the week talking about private markets. Just red hot, the enthusiasm to move into private markets. You've been there for a long time. Can you talk to us about how participants in private markets are changing and what that means for what you do every single day?
Well, it's great to see new entrants because that actually allows you to have people who might want to buy your assets. So I guess I could say in infrastructure at the moment, would you like some of our portfolio? Because certainly there are plenty of people talking that up. I think for us where we struggle a little bit is where it adjusts the pricing to levels which we don't find attractive. And I think in infrastructure particularly, which is one of the hotter areas of this week in terms of some of the disclosures around BlackRock and others, we are finding that some of the more interesting projects are priced to a level where it's quite hard to say it's giving us a full risk-adjusted return.
Do you see the same in equity after some of the valuations we've seen in private markets over the last few years?
You know, I think if you ask most people at Davos this week, they would say they're really keen on credit. And why they're keen on credit? Because they don't like equity so much.
Yeah.
And you can participate in credit at the moment at a sort of mid-teens return, and actually there's a lot less risk attached to it, so it looks pretty good.
At this point, we were also hearing, for example, from Golden Tree Asset Management, he was saying he likes single B and he's going into public credit, which is ironic to your point. Are you kind of moving in that direction too, just trying to lock it up, hold it to maturity, and there's your return that you're looking for?
You know, in all the years I've operated in and around credit, I've never really been able to hold it to maturity yet. So maybe that's an impossible dream we're all looking at. I think that the issue to us with credit, we do some private credit in and around all of our activities, and you can hold that for longer. But a lot of the book turns over pretty rapidly. So that's one of the challenges, is you have to be quite active.
What's your bogey? I know that we talked about pension plans and the 8% bogey and how infeasible it was in the years of zero rates. What's the bogey that's realistic now for you?
Well, we still aspire for that 4% real. So if you take Canada at the moment, say it's about 3.5%, that's about 7.5% rate of return. Is that bogey real or not? Well, we've done 10% broadly since inception, so that would sound like it should be possible. I think one of the challenges is we're seeing some of the higher rate asset classes that we're in, private equity, venture, really sort of slowing down in terms of returns we're seeing. So why is that? The businesses aren't growing as much as they were. We're holding them longer, which also affects your rates of return. And I think you've just got to work harder in making them grow.
I want to set the scene a little bit earlier in the week. Day one in Davos, Switzerland, we do an early morning forum, a panel on private markets. And towards the end of the panel, we ask about politics and 2024 elections and President Trump. And Joe,
ask me again.
The room just goes silent. No one wants to go there. Blythe Master starts answering her own question about what's happening in fintech.
You told me about
Doesn't
that.
want to go there. Joe, you will go there. Not specifically on the former president, but the direction of travel here. It feels like the walls are going up, not just in the United States, but worldwide. You're based in Canada. You need to invest internationally. You and I were talking about this. Can you walk us through the consequences, the complications around elections in 2024?
Okay. Well, I think the right answer to that question is it's complicated already. So it's potentially going to get more complicated, but I think anybody trying to invest in the US should say there's already complications. I think there's a degree of an America First sentiment existing, and that may be amplified as we go forward towards November. From our point of view, I think the interesting thing that we've largely adopted as a strategy for the US is a state-by-state approach to where we want to invest. So if you're Canadian, you're probably seen it initially as being a bit more left of centre than many people down in the US. We look after teachers who are left of centre again of that community. So I think for us, we've really got to be careful in things like healthcare and other issues where it is a bit more of a politically sensitive area in terms of how we want to operate and will it be consistent with that area. And probably the zone where we'll probably be looking at it most carefully be in two areas. So one is things like infrastructure, where we need a state approval to be able to operate. Doesn't really apply to the federal overlay so much. And when you come to the federal overlay, it's really their reaction to when we invest somewhere else in the world. So we can operate in some businesses in China and other parts of the world where it's now seemed to be in a strategically sensitive area, which may limit our opportunities in the US.
It's interesting you brought up healthcare. Clearly, the abortion issue is absolutely massive right now in the United States. Is it too simplistic to say one state is easier to do business than the other, given what you just said? Because typically, I think we'd have a conversation about doing business in America. We'd say Texas good, California hard. When I hear you say those things about healthcare, it doesn't sound that way at all.
I think it's somewhere in the middle. So I think there is some truth of it's easier in some states than others without any question. But everything has subtleties to it. So it depends what area of healthcare you really want to be present in. And a lot of the sort of the outsourced treatments, I mean, I think that probably gets a bit more difficult because it's on the periphery of what's actually fully adopted.
Joe, this was fascinating. I'd love to do it again soon. It's just been great to catch up with you over the last couple of weeks. That was Joe Taylor of the Ontario Teachers Pension Plan. Bramo, a lot to chew on in that conversation.
That was fascinating to me. Back to back, Adam Posen and Joe there talking about how policies aren't that much different than they were under Trump as they are under Biden, and how everyone's already kind of adapting to that internationally.
It's not the federal story. It's what's happening at the state level. MH, that comes up again and again and again. I think back to Mike Wirth and Chevron earlier on this week. We're talking about the ease of doing business somewhere like Texas versus, say, somewhere like California. And you get a different flavour of things when you start talking about healthcare.
And it's exactly why Governor Kemp came to Davos from Georgia, because he's making these deals, especially for clean energy, into his state.
That's the politics. We'll pair it with the economics. Up next, Nobel laureate Michael Spence with us in Davos, Switzerland on day 3 of the World Economic Forum. Check out the equity market on equity futures right now on the S&P 500, trying to bounce on the S&P after 2 days of losses, up by 1/3 of 1%.
You're going to have more volatility going forward. Returns are likely going to be lower in the next decade.
At this particular moment in the markets, tail risk is higher.
I have no idea how to interpret the market. It seems very sanguine.
Right now, particularly ending the year with the melt-up, there's just too much broad optimism.
We think earnings are growing. The street thinks 11%. We think half.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
It's day 3 in Davos, Switzerland, and everyone you meet says the same thing. I can't wait to go home. I can't wait to go home.
You are so right.
It's like 3 days is just enough for absolutely everyone. I would say 2, maybe. From Davos, Switzerland, for our audience worldwide at the World Economic Forum, good afternoon. Good afternoon. This is Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro. Together this week with Annmarie Hordern, with your equity market on the S&P 500 positive by 0.3%, bouncing back by a few days of losses. Lisa, the data's been good, and we've had a ton of pushback from central bankers. With that data, I think, really reinforcing the message.
It seems like the more optimistic we hear from a lot more optimism that we hear from the business leaders here at Davos, the more pessimism we hear from some of the central bankers who are saying, hold up, you keep acting like this and we're not going to get to where we're going and we're not going to be able to cut rates at all. So that seems to be the tension right now between some of the policymakers and some of the business leaders.
I'd say for the politicians, typically you come to a place like this, we've all been here a few times, the politicians usually get a feeling of that it's kumbaya. You mentioned this yesterday.
Yeah.
Nothing kumbaya about this moment. There are so many massive issues. If you can be constructive on the economy, and we can talk about whether you can, that's a conversation. I don't think you can be constructive on the dialogue when it comes to geopolitics, Annmarie, in any way, shape or form.
No, it's the big overhang over this Davos. It's not just a business meeting. It definitely feels like a foreign policy meeting as well because of what's happening with Ukraine. President Zelensky was here making his pitch. But of course, Lisa, you mentioned we have the Iranian foreign minister here at a time when Pakistan and Iran are having a tit for tat, and Iranian-backed groups, whether it's Hamas, Lebanese Hezbollah, whether it's Houthis, are causing conflict in the Middle East.
Which explains why there are basically armies of police officers everywhere you go, and there are people who are at checkpoints that are high up there with huge guns that are looking out over all this. So it definitely seems like there is a very big military presence here as a result of some of this. That is the elephant in the room that might stymie some of the optimism. But for the people who are actually on the ground doing deals, looking at what consumers are spending, if you look at what they're doing, it's not that dire. And I think that divergence just keeps coming out again and again.
I have to say, Lisa almost scared me a little bit earlier on. We sat down, put the microphones on, I log into the Bloomberg terminal, and Lisa sounds optimistic based on what she's heard in Davos, Switzerland.
Hold up.
What's the caveat to that?
The caveat is that the world could fall apart as people are worrying about, right? I mean, there are so many things that could happen. If it's inflationary in the Red Sea, although people are kind of poo-pooing that. Whether it's something massive about disruptions with trade, people are poo-pooing that too. So, I mean, these are some of the things that people are kind of taking off the table.
I'm just trying to work out what Happy Valley has done to Bramo over the last 3 days.
We'll analyze that in detail.
Okay. In the equity market right now, on the S&P 500. That's the next hour on this show.
Please, let's not.
Equities bouncing back by 1/3 of 1%. In the bond market, yields are a little bit lower after climbing higher over the last few days. Lisa, we are at 4.08% on a 10-year.
What we're looking forward to this hour, we've got some incredible conversations, including Ted Pick, Morgan Stanley CEO, Brian Moynihan, CEO of Bank of America. I just want to say all the banks, their CEOs have been so optimistic about what's ahead in terms of deals and people actually coming together. James Quincy, chairman of the CEO and CEO of Coca-Cola. We could talk all about price increases, but also Ozempic, and Dmitry Kuleba, Ukraine foreign minister. But right now, I've got to say, on the macro geopolitical level, there is nobody more important than our next guest, John.
Just absolutely fantastic. Michael Spence, the Nobel laureate and senior advisor at General Atlantic. Mike, good afternoon. It's good to see you.
It's great to see you all.
Just great to catch up, sir. The author of Perma Crisis, together with Gordon Brown and Mohammed Al-Arian. We reflected on AI together.
Yes.
just last year when that book came out. You've been on a panel this week about artificial intelligence. We're going to do the doom and the gloom. You're going to do the optimism. Right. Why should we be optimistic about this technology?
Because, deployed widely, it has the potential to produce an enormous productivity surge, relax the supply side constraints, relieve the potential inflationary pressures, and so on. Not tomorrow, not, maybe by the end of the year, but by the end of the decade, we could be on a completely different sustainable growth trajectory. So that's the optimistic one. It's not to dismiss the downside stuff. That's important, but you need a balance, right? And what you don't want to do is focus on the downside and then skip this enormously powerful tool we've been handed.
So I'll focus on the downside and you can convert me maybe.
Okay.
I asked the question in the last hour. In fact, I asked it of you as well last year too.
Yeah.
Globalization decimated manufacturing bases in places like America. A lot of jobs were displaced. A lot of people were out of a job, out of a career, and some of those towns are still suffering.
Yep.
There is a fear that this advancement in technology will do the same thing but to services. Is that wrong?
Yes. And the reason is what I call the automation bias. People think, and for a good reason, right? The Turing trap that Eric Brynjolfsson talks about, says Alan Turing, was trying to figure out how much progress we'd made in AI by figuring out whether we had a machine that when we talked to it, we thought we were talking to another human being. And we benchmark AI routinely against human performance. And that's also a fairly natural step. It's the next step that's problematic. Okay, so when people see this, the machines do images better than humans, then people say, why don't we replace the humans? Okay, but the AIs we have now are prediction machines. They write the first draft brilliantly. They may put some people out of business, but their best and most natural use is as powerful digital assistants, and the model's machine-human collaboration, not wiping the humans out.
What scares me, John was saying I sound really optimistic. I'm not about this, and I have to say, I've heard a lot about the potential to disrupt the financial system pretty dramatically using artificial intelligence and hacking into different systems and putting out there misinformation of all sorts. Yep. We're seeing all of the elections and this question around what kind of interference could really come to the fore. Cyber battles on that front with artificial intelligence. How do you sort of put that aside and just focus on the optimism?
No, you don't put it aside. So what James and I said, when we wrote this paper in Foreign Affairs is you just definitely don't put that aside, Lisa, right? That's serious. You've got copyright issues. You've got, misuse of a whole variety of kinds. What you do is balance it, with a program on the public policy side to make sure that this stuff doesn't end up in J.P. Morgan and a few other large entities, and and everybody else, like small and medium-sized businesses, sectors, are missing in action. So we're not saying it's either this or this. We're saying we need both.
So, because we're in Europe, I feel like we have to ask this question: does it need to be regulated across multinational countries?
Yes. Right, because of the way the internet works, right? You got election interference, flooding the system with, extremely plausible sounding misinformation or biases and all that kind of thing. You can't regulate that just one off unless you close off your internet, right? Maybe the Chinese can do it because that internet is relatively isolated from the rest of the world, but for the rest of us, I think we need a global process as well as domestic regulation, for sure.
How are you looking at how AI is going to play into the election? We've already seen some, changes in ads because it was AI generated, different people's voices, and people view that as actual truth and fact.
Yeah, so I think we have to regulate that out of the system. And we don't know exactly how to do that. And it varies depending on where you are. I mean, if you listen carefully to the commentary on this, Europe has a very different attitude toward that. I was listening to the Minister of Communication in Singapore, a member of our panel yesterday. They said, I know this probably won't work in the United States or in Europe, but when we see something that's problematic, we remove it. Period. Right? I mean, and you might say, well, so... And she made the point, I think correctly, that we're not going to all end up all in the same place on this round. I mean, on this kind of issue. But I have a little bit of sympathy for the Singapore approach. I mean, if this is just clearly destructive, maybe we should have the battle with the polarized free speech lobby. But anyway, it's not for me to decide.
No, you went there, so let's talk about it.
Yep.
How do you think these systems are going to change? Capitalism, free markets. I do wonder how things are going to shift, and maybe quite dramatically.
Well, they're already changing it. I mean, I was talking to somebody, I won't name him, but, in the core of this, we're going to have these AI systems on this by the end of the year, for sure. There'll be mini versions of the big ones, but they'll be pretty powerful. It's going to change everything, Sean. I mean, we're just going to have powerful AI digital assistants, right beside us all the time.
But you've mentioned maybe losing civil liberties. And I do wonder what the cost-benefit analysis of that actually looks like.
I'm not so worried about that. I mean, there is a longer-term discussion, about when these things become, 2 orders of magnitude more powerful than they are now, or whether they really are somewhere near, sort of artificial general intelligence. But I think we're a fairly long way away from that. So what we've really got is just powerful tools in our hands, and it's up to us to decide how to use them. So I don't want to be Pollyannish about it, but I just think it would be a terrible shame in a world that has labor shortages, fragmenting supply chains, lots of, supply-side constraints, to throw away the most powerful tool we have for producing a productivity surge and growth.
There's a sensitive issue that sort of is the drumbeat under a lot of the jobs questions,
Yep.
which is that there are a lot of people who are not employed and who are not employable. And I'm wondering, as the world becomes more technologically advanced, you need to have some skill to be able to use these technologies. Will that part of the population grow, where it basically becomes that much more bifurcated between the people who are educated and have skills and those who don't?
It's an important question, but I think the trends are on our side. First of all, there's 2 hallmarks of Gen AI, that you can see in the large language models. One is that they're multi-domain. They switch domains the way humans do, and that's the first time ever that is, I think, the biggest surprise that they got, because even the people who did it didn't think this was going to be as effective in that dimension. But the other one, apropos your point, is that you don't need a whole lot of technical training. You just talk to them, and they talk back, right? Or do what you say. And so I think this is the most, of the advanced technologies, one of the most accessible, right? Where it's less likely that we'll trap people away. So when I look out across the world, I see 800 million mobile internet users in India. That's great. I see places where that's not as powerful a trend. I worry about that because they won't have the infrastructure or the tools to be part of this. But are there a whole bunch of people in the category of nursing who are going to have powerful digital assistants that won't be able to use them? I don't see it.
Who do you think is going to win the AI race? Is it going to be the U.S.? Is it going to be China?
Neither. I mean, they're both powerhouses. The only difference between now and 5 years ago is that the research and development community in AI was integrated, and now it's completely bifurcated, right? They can't even talk to each other, and that's geopolitical tensions and national security issues. But beyond that, I don't see either one flat out winning. I know we're trying to hold them back by denying them access to various things, the lithography, the most advanced chips, and so on. But I don't know how much it'll hold them back permanently. I doubt it.
Mike, I'm a stubborn guy. I'm not converted. Going to have to keep trying. Michael Spence, thank you, sir, of General Atlantic, the Nobel laureate, giving us a lot to think about on that topic. Bramo, converted?
On AI?
Yeah.
Well, I think that there are going to be good applications. I'm just not convinced that the regulators can move fast enough to regulate something that's moving at light speed with the top-paid executives and top-paid tech creators. How does the government compete with that?
That's where I struggle too.
That's the issue.
Yeah, that's where I really, really struggle. Fantastic to catch up with the absolutely wonderful, the brilliant Michael Spence. Coming up on this programme, Samantha Power of the US Agency for International Development. That conversation is just around a corner. Equities attempting to bounce up by something like 1/3 of 1% on the S&P 500 through most of this morning in New York.
we have delivered very tough messages to Iran, including I had a discussion with the foreign minister last week. And obviously there's a number of sanctions and other measures already in place. But I think it's absolutely vital that we send a very clear and unequivocal message to Iran that its behavior in supporting these proxies, whether it's Hamas or Hezbollah or indeed the Iranian armed groups in Iraq and Syria, its behavior is unacceptable.
I'm told we shouldn't have favourites, but that was my favourite interview of yesterday. That was David Cameron, the British Foreign Secretary. Favourite because I think we could have conducted that interview for another 30, 45 minutes, Bramo. We didn't even get to Brexit and his role in that, his departure, his return to politics. Before we even go there, we need to talk about the Middle East. Yeah. It's been absolutely dreadful what's been unfolding in the Middle East over the last 3 months. It's starting to have a real economic impact as well, Annmarie, given what's developing more recently in the Red Sea.
Absolutely. There's a situation in Gaza, of course, but then there's these Houthi militants that are firing at commercial vessels. At the same time, we now have a tit-for-tat between Iran and Pakistan. And the question we asked David Cameron is, don't all these roads, whether it's Hamas, whether it's Houthis, whether it's Lebanese Hezbollah, lead to Iran?
And there's also a question of what is the main agency that kind of conducts some sort of diplomacy between these, because the United Nations hasn't exactly played that role. There's been a real question of who plays the middleman in this, and actually it's emerged as Qatar, which you actually mentioned as being here. But it's a real shifting in sort of the global power structure of where things actually get done.
Let's talk about some of those issues right now. We're lucky to be joined by Samantha Power, the Administrator for the United States Agency for International Development and former U.S. Ambassador to the United Nations. Samantha, it's good to see you.
Good to be here.
Thank you for being with us. Can we just lean on your experience at the United Nations? We have people like Jamie Dimon of JP Morgan talking about how dangerous the world is right now. From your perspective, how dangerous is it?
Well, objectively, you have more displacement on planet Earth than we've had since Hitler. That's bad. We have more conflict happening today than in more than 30 years. But I will say one of the priorities that President Biden had in coming into office was to rebuild alliances, to get democracies delivering for their citizens, to try to fight back against some of the more authoritarian trends, which are not just in big countries, but we've actually seen a fair amount of democratic backsliding, including in established democracies where election results and so forth are challenged. So, you know, I think what we see when it comes to Ukraine or even the humanitarian response to Gaza is more countries digging deep to provide more humanitarian assistance. There is a lot of diplomacy going on behind the scenes, for sure, including thinking, for example, in the Gaza situation about longer term, a two-state solution, getting that political process back on track. But there are a lot of stakeholders, as you say. There are a lot of countries who are involved in that. And again, we pride ourselves in reaching out to many of those countries and making sure that we're organized, because my agency is not going to be able to deal with all the humanitarian symptoms in the world. We have to deal with root causes and end these conflicts, you know, so that the citizens aren't suffering to the extent that they are today.
This might be a difficult question for you to answer, but how problematic is it for you to deal with humanitarian aid that's needed to get into Gaza when the United States vetoes ceasefires at the United Nations?
Well, part of the challenge, of course, is that the very people behind October 7th are still at large, still want to kill Israelis. And while those capabilities exist, of course, the military effort is continuing. We have managed to increase humanitarian assistance that is flowing in, but not enough. And there's a major food crisis imperiling the people of Gaza that USAID is, through our partners on the front lines, of trying to respond to. So we think it's incredibly important to work behind the scenes with the Israeli government, with the Egyptian government, with all stakeholders to increase that pipeline. I was in Egypt about a month ago and just saw the backlog of truck after truck after truck drivers who had food and medical supplies to deliver to the people of Gaza, who had to sleep in their trucks for 3 or 4 days waiting for permission to clear.
But why is that? Because the U.S. is in touch with the Israelis. They give them the aid. Shouldn't there be more leverage in pushing on them to?
Well, I think you've seen the exercise of that leverage to get us where we are, but we're not. Nobody can be satisfied, again, given the condition of civilians inside Gaza. But again, remember how October 7th happened. A lot got into Gaza, and it got in through channels that, you know, when the after action is done, we will better understand. But you can understand why people who have just gone through the experience of having more than 1,000 civilians brutally murdered and all these hostages taken Blinken would be cautious about just open sesame and letting everything in. But gradually we're getting more and more points of entry opened. And again, we need to get the number of trucks, humanitarian and commercial, way up beyond where we are today.
To build on what Annmarie is talking about, the U.S.'s leverage, how much has it declined as its role has become maybe muddied on the international stage? And I ask this of you, someone who's been on the international stage representing the U.S. for decades. How much have we lost clout in the U.S.?
Well, as one who was ambassador to the UN, a member of President Obama's cabinet, and then came back, certainly our alliances had eroded in the intervening 4 years, and that is why Secretary Blinken and the President have invested so much in restoring those alliances, because alliances aren't popularity contests. They are networks that you leverage at times of crisis. Look, we're here at Davos. I don't feel right now any loss of leverage. You know, I'm trying to get the world to rally together to end plastic pollution. The number of major CEOs that show up to be part of that coalition is extraordinary. We're trying to end lead poisoning in developing countries. 1 in 2 kids in developing countries have elevated levels of blood, lead levels in their blood. Again, philanthropists, foundations, other governments stepping up. And Ukraine is probably the best example, where U.S. investment, every dollar that U.S. aid and other U.S. agencies have invested has brought $2 in from other donors. So the leverage is real.
As someone who used to be the ambassador to the UN, is the UN relevant anymore?
The UN is countries. The UN is, Richard Holbrooke, the late great diplomat, used to say, blaming the UN for the world's problems is like blaming Madison Square Garden when the New York Knicks play badly. You're blaming a building. We need countries to change.
And I don't like MSG.
The Knicks are playing better now, but it's the countries who constitute the UN who should not be abetting transnational crime, who should be standing up and enforcing sanctions against countries like Iran that are fueling these militant movements. It is the countries at the UN, for example, not that long ago, a few weeks ago, that stood up against the Houthi attacks on commercial shipping. Why? Because those countries recognize that their interests are at stake, that as food prices grow up because of these attacks, that's going to affect people in countries around the world. But there's too much polarization, and there are fewer democracies within the UN now than there were 10 years ago. So we also need to see democratization proceed and an end to the march of authoritarianism, because authoritarians, in repressing their people, also prevent there from being the kind of accountability that you need to see more prosperity. When you have less prosperity, more people who can't get access to jobs, who can't criticize corruption in their own neighborhoods, that's a doom loop in terms of more extremism, more instability. So, again, governance and economic development are very linked, and people have tried to separate them of late in a way that's not helpful.
We have about 60 seconds left. I want to squeeze this question in. There's a bit of a division that's emerged, and I would say it's been exacerbated by what's taken place in the Middle East over the last 3 months. A division between the administration you represent and the younger population who would typically vote Democrat. How do you close that gap over the next 8 months?
Well, it's not my job to talk about domestic politics at all. I will just quote President Biden, who says always, don't compare me to the almighty, compare me to the alternative. So I think that's the nature of the argument. And, when you think about the kinds of values that young people have, wanting to protect the natural world, wanting to fight climate change, for example, that's a leading, animating issue for young people, that the choice, I'm sure, will be evident.
Samantha Power, it's good to see you. Thanks for being with us. Thank you very much. Of the U.S. Agency for International Development. Coming up on this programme, Steve Pagliuca, the founder and CEO of Pags Group, the owner of the Boston Celtics, and an Italian team called Atalanta who beat my beloved AC Milan last week. And I wake up to a text from Steve Pagliuca himself just to show me the highlights. A YouTube link.
Brutal.
Yeah, what do you think we're going to be talking about next? OK, from Davos, Switzerland, at the World Economic Forum, this is Bloomberg.
Roll the pasta out, maybe.
Got a really nice warm welcome from our next guest in a commercial break, accusing me of, what was it, fake news?
Yeah.
Fake news. Okay. Really excited about our next conversation. Cannot wait. Let's get to the equity market. We'll give you a market check and then we'll bring in our next guest. Equities look like this on the S&P 500. 2 days of losses, now up 0.4%. The Nasdaq up by 0.8%. The bank earnings are behind us. We'll catch up with Ted Picker, Morgan Stanley later on this afternoon. We'll also be speaking to Brian Moynihan of Bank of America. And then it's over, Lisa, to big tech. We'll start to get earnings from them over the next couple of weeks.
And arguably that will be more of a bellwether on the U.S. economy, or at least for U.S. stock markets, considering the weighting, than even the banks. And to me, Apple, you really raised this earlier, Apple's the main question, especially given the downgrades now with the Apple Watch that actually is going to be taken off if it doesn't have a blood sensor, blood oxygen sensor, and a whole host of other potential challenges.
Why don't they just pay the company? Why don't they just pay the company so that they can use the technology? I don't understand. Are they still saying that they haven't taken that technology for someone else?
I'm sure there's
being litigated at the
It's still being litigated.
It's being litigated, so
Okay.
I'm not going to weigh in.
But you can buy the
Probably
watch
a wise
here.
decision.
You can buy the watch here if you want the
as you
feature.
said, I think
Buy
you
it in
can go to
Zurich.
Best Buy, can't you? It's just Apple can't physically sell them. Is that right?
Or distribute them or whatever.
Right.
Look, I'm not an expert in this, but I didn't even realize they had Best Buy in Europe. That's all I can say.
No, I'm not saying they do.
No.
I'm just saying you can go home.
Okay, there was something else.
Best Buy.
All right, let's move on. All right, bonds look like this. 2-year, 10-year, 30-year. Yields climbing in the last 24 hours off the back of some comments from Governor Waller of the Federal Reserve. Put that together with the data we saw yesterday, which we really haven't talked much about so far this afternoon. We need to talk about US retail sales, just hot, pushing back against this idea of weakness and rate cuts coming in March.
And honestly, to me, this has been one of the biggest interesting drivers of the market activity is that we've got better than expected data, better than expected forward-looking indicators from the Beige Book. So this raises a question, and I mentioned this before, but how much of this can come as growth that's not inflationary? Can we still see the disinflation continue without any kind of hit to the growth, the sort of soft landing or no landing that some people are talking about?
Let's finish on foreign exchange.
Move on.
Let's move on. The euro against the dollar, something like 108, 109 over the last few weeks or so. Moving the GDP of Italy and maybe the Eurozone is Steve Pagliuca, the founder and CEO of Pax Group, senior advisor at Bain Capital, owner of the Boston Celtics and an Italian club called Atalanta. Thank you for the text just last week. Thank you very much. Defeating my beloved AC Milan. How much fun are you having? It just seems like you're having a blast right now.
It's been a good year. I don't want it to end. 2024 open up in a good way. The Celtics are winning, Atalanta's winning, and the markets are doing well. So
let's get to the NBA first. So Cuban getting out of the Mavericks. Some people talking about peak valuations of NBA franchises. Can you give us your view on that development?
You know, I don't think they've peaked at all yet. Basketball is a global sport. I invested in soccer. It's a global sport. With streaming, you know, I watched the game actually last night. I watched the Celtics game on my phone last night. So we haven't really penetrated all the markets. Media rights are still going up. And so the programming, it's the only programming, I think, the top 10 of the 10 rated shows in the U.S. were sports program.
Let's talk about that. NFL is absolutely crushing it. Let's build on the NBA. It feels like, in the minds of some, so let me give you that perspective, that we're hitting this ceiling, that the broadcasters never really truly own the asset, they rent it. They're finding that it's getting really expensive, and they're trying to work out where on earth to put it. Do you land it on Peacock, on a streaming device? Do you get it to as many homes as you possibly can through cable? Cable's dying. What do we do? What do you see further down the road that suggests to you that media rights, TV rights for sports like basketball can keep climbing?
Well, we're in a period now, as you guys have followed media, been media investing the last 30 years. You've had bundling, unbundling, rebundling, unbundling. We were in a big unbundling phase. You know, streaming coming in with cable, with linear TV, and what that means is the new internet players, you know, Google, Facebook, they all want programming for people to watch content. So content is more and more valuable. NBA content's hugely valuable, and so they're fighting over that. I think you'll see some consolidation. You'll see these streamers consolidating, you know, back to the bundling, because it's inefficient to have multiple software systems, you know, multiple marketing. So you'll see a rebundling, but the programming will always be valuable because it's the only thing that really aggregates eyeballs. And so I don't think we're through with those rates going up for premier sports like NBA and NFL.
Are buying sports teams better than buying regular companies?
If you win, it's better.
I wonder, is it a better investment?
It's really bad when you lose.
Okay,
when
but
you see
it's
a
a better
sign,
investment.
you fire the owner.
Well, I'm going to ask this because, the entire Middle East delegation here is trying to buy the whole host of different football clubs in Europe. You see this as sort of the hot investment. At what point is it too hot to handle? And this is sort of what happened in certain spheres of private equity during some of the boom times that turned into bust times.
Well, it's turned out that we didn't buy the Celtics. We didn't have a presentation of 17% IRR. It was like banner 17. We did it as a labor of love. So I have to say, I certainly didn't predict the values what has happened in sports. But it turns out that sports has been a very good business because of this dynamic of people battling for eyeballs. And then secondly, it is a fun investment. People like to be part of tribes. And sports is a great feeling. Even some people like AC Milan. Versus
it's also a great feeling unless they get hammered by your team.
It's a great feeling to be part of this club. And when we bought the team in 2003, they barely had contact with any of their customers. I don't think they even had the emails. And there was no Facebook. There was no Twitter, now X. So what's happened is technology has allowed the fans to get right up close to the players, to really be part of the club, be more engaged. And then now you have gambling coming in, betting coming in, which makes them further engaged. So it's an out-of-body experience when you walk into the Boston Garden and you feel that vibe, and you feel it on television, and technology is making it easier.
I love how John opened it up. It seems like you're having so much fun, and you're having fun with the tribe of sports, but you're also having fun with the tribe of artificial intelligence, which is basically permeating every corner of this get-together. And I'm wondering, you've invested in companies for many, many years. What proportion of some of these AI companies and initiatives do you think are actually going to come to fruition and be valuable?
That's a great question, Lisa. It reminds me of 1999. I was going out to California, and people would come in with a term sheet and said, "Okay, you have 2 hours to invest in this company that's going to sell medical products on the internet." Is there a plan? No, it's the internet. And valuation is $100 million. We have no sales. So I turned many of those down. There are now 1,000 artificial intelligence companies. If you walk around Davos here, I think they should change it to the Artificial Intelligence Forum this year. Everything seems to be ubiquitous artificial intelligence. That being said, I think we are in the experimentation phase. The CEOs have not implemented this in a big way yet. The technology still has a ways to come. But I think it'll be just as revolutionary as the internet was. Right now, I don't think people realize a model like ChatGPT, because it basically is a brute force transformer model. It cost $400 million just in GPU to program it, to make the large language model. So Liquid AI, a company we've invested into, the thesis from MIT is they can configure the software more like the brain. So they have 900, let's say, nodes versus 100,000 nodes in ChatGPT. So you can program a large language model for probably a 15th or 20th of the cost. So you're going to need that cost to come down, because if you think about all these models, if everybody built one of those models, you take up half the power in the United States. So I think we're still in the experimentation stage, and CEOs are saying, thoughtful CEOs are looking at this and saying, where can I put it in my business? How can I make it secure? If you build your own large language model with today's technology, it's $300–400 million, so that's not going to happen. So new technologies are going to have to come out to make it cheaper, more efficient, and more secure.
When did you begin to become interested in all of this, Steve?
30 years ago, I started a technology fund at Bain Capital called Information Partners, and in fact, I wrote a presentation for a conference in Aspen. It looks like caveman now, but it was called Convergence.
Yeah.
And I was saying that what's going to happen is the telephone and the television and computers were going to converge, so we'd have a different experience. Now, little did I know that Apple would come out with the iPhone and all the rest of it. But I've been interested in tech and been a tech investor and consultant for many, many years, and been through the internet boom, the craziness of, literally, I'm standing in California in 1990. These term sheets are coming in.
I'll bet.
And this is crazy. And now that's happening again on AI. But AI is going to have a huge impact, productivity. It's going to be great for the United States, because I think it's going to be the next productivity wave. And I'm not one of those that is scared of it. To me, it is a supersized slide rule. When I was Methuselah at accounting, studying accounting, I used to use a slide rule and look at a table. and they said, oh, the computer's coming in, HP 12C, it's going to ruin our minds. It doesn't. It's a tool that's going to expand our capabilities, and AI is incredible.
Mike Spence said the same thing, Nobel laureate, General Atlantic, working over there with Bill Ford. We talked to him about 40 minutes ago. Is there anything about it that concerns you? Anything whatsoever? Is there something, let's say you get some term sheets. I want you to draw a distinction between the companies you would work with and the companies you're worried about because you think they'll do more harm than good. How do you draw that distinction?
Well, that's a great question. It's a tough one. I would compare it to anything else. Like nuclear power was great. Nuclear bombs can destroy the world, right? If you have bad actors. So artificial intelligence, if you have a bad actor behind it, it's going to be a problem. So what's going to have to happen is you're going to have a regulation. You're going to have people watching the internet. You're going to have people punishing and thinking about security. So again, I view it as a tool. But it's a tool that can be misused. So there's going to have to be a certain amount of regulation and a certain amount of more security and more watching what is happening by the world.
On the flip side, are there any companies that you're seeing? Are there areas of artificial intelligence that you're seeing where you think companies are going to become the next Facebook or Apple?
That's there's two schools of thought. One school of thought would be one company, maybe ChatGPT, is going to merge and become the Google, of artificial intelligence. Another school of thought is these models will come down in price, which I would say liquid AI is one that can drive that price down, and you will get many large language models that are usable. And secondly, you'll focus on verticals. So there'll be artificial intelligence for medical. So it doesn't make sense for a medical artificial intelligence system to go out and read, the Mozart symphony. It has no relevance to medicine. So I'm in the camp that believes there'll be a hybrid system. There'll be a few foundational models people will use. They'll be large, but they'll be foundational. And then there'll be probably companies that can capture vertical markets. And so you'll have it'll be a network effect. There'll be a company that captures medical, a company that captures industrial, et cetera.
Before we let you go, you mentioned 1999, and we can't let that slide. If we're looking at another 99 internet bubble-like boom in artificial intelligence, is there going to be some kind of bust, and how painful will it be?
Yeah, there's always busts after the boom, for sure. The good news is these companies are requiring equity, so it's not debt, so it's not going to have a systemic effect. But there will be a bust of people who invested in every single thing that had the word AI in front of it, and there'll be a carnage, and then there'll be the companies will emerge, the best companies will emerge, and there'll be several of them. And I think, again, different than Google dominating search, there'll be companies that really dominate vertical markets. And by the way, if there is a disruptor, you think about AT&T used to dominate the phone business, and then everything became fragmented. Google looks unassailable, but if there is a disruptor, it'll be an AI company that gets you a better search. So when you say, I want to know what the best pasta is, it won't give you 5 articles. It'll give you a recipe for the pasta and why it's the right pasta and who's the person that invented the recipe. That will be a big disruptor for Google. That's why Google is spending so much money into AI. Microsoft as well. They want to protect their position. So I think we're in a great era where there will be some disruptors coming in, and life may change. It won't be all Google. It'll be an artificial intelligence company that gets us better data. You don't need to spend $400 million to find out the answer to that. There is only one answer. It's non-us. It's always non-us, right? Always. That is the correct answer. ChatGPT should know the answer.
Your grandmother made the perfect pasta. Don't ever think anything
Puglia,
else.
There is no challenge to that.
Was it really good?
Steve will say the same thing about his grandmother too, and then we'll fight over it. Steve Paliuka of Packard.
My grandmother used to roll it out on the table and cut the individual pasta every Sunday.
Oh my gosh!
So I didn't know I grew up in a gourmet restaurant.
Can I come over?
used to make the sauces at the back of the apartment building. They'd have these big sort of oil canisters and make the tomato sauce.
My
at the end
family
of
still
summer.
does that.
Oh, just amazing!
Canning it.
She
200 cans.
She used to wake up at 6 in the morning and make fried pizza dough for me when I was a kid.
I love it.
I had breakfast every Saturday and Sunday.
Steve, you're taking me back.
It was a good life.
Yeah, I didn't have that. That was good.
Honestly, the food there
is so much better.
That was like a 3 Michelin star restaurant, and like you say, Steve had no idea it was that good at the time. You try and find that elsewhere, you cannot find it.
We have to get you a Canada Goose coat, John, on the company Bain Capital invested in.
Of course, yes.
It's the warmest coat in Davos.
Okay, there's the sales pitch. James Soon, CEO of Trip.com, coming up next.
COVID has shown that there's a huge pent-up demand. That hasn't eased. I think people thought this revenge travel would ease down. I mean, it was hard getting here. And I think elasticity on pricing is good, coupled with ancillary. So I think airlines are in a good position, whatever the shocks are. Oil is still, despite all the geopolitics, there's a lot of supply.
Steve Pagliuca trying to exchange coats in a commercial break. He does not want this one on TV anymore. That was Tony Fernandez, AirAsia CEO. That's what that was about, wasn't it?
He's going to troll you all day long.
He wanted a commercial for Canada Goose live on Bloomberg TV. Okay, Steve, you've got to pay for that.
And the Celtics.
Yeah. Okay. Well, he got that for free.
Yes.
Okay. Let's turn to financial markets briefly and squeeze in some of the price action for you in the equity market on the S&P 500. It is a day of gains, a morning of gains in New York City for now at least, up by 0.5% on the S&P 500. Yields are coming in by a single basis point, 4.09% on a 10-year. Just a story this week of central bank pushback. Wonderful to see Francine's interview with President Lagarde of the ECB on the front page of the Financial Times a little bit early this morning when I picked up the newspaper. Pushback from Lagarde, pushback from Waller, I think endorsed by the economic data Bramo we saw yesterday in the United States.
And not just the economic data, also some of the rhetoric that we're hearing from CEOs that actually have some sort of incentive not to lie blatantly before they put out some sort of economic projections. All of them are talking with real positive kinds of tones about the potential for consumer spending to continue just as robustly as we've already seen it.
Let's find out what's going on in China. We can have that conversation with Jane Soon, the CEO of Trip.com. Jane, good afternoon.
Good afternoon.
Largest online travel platform in China. That is a big deal. So give us an idea of what's happening with the Chinese consumer, because what we're told in the United States is that confidence is shot. It is broken. It is not bouncing back. What do you see in the business?
Yeah, for our business, it's doing very well. We have 4 segments. The first one is domestic travel. Not only we recover fully to 2019, we far exceeded 2019 by more than 50%. The second part is outbound travel, which is to bring Chinese travelers from China to the rest of the world. So we look at both demand side on our search as well as the supply side. The demand side already exceeded 2019 level. However, on the supply side, we still have 2 major hurdles. The first one is the visa application still takes too long, particularly to Europe and to the United States. The second hurdle is the flight capacity and shortage of the labor. I'm very hopeful in 2024 we'll do better in that segment.
I'm curious, though, whether Chinese consumers want to travel to Europe and the U.S. in the same kind of numbers as we saw in 2019, or has something shifted as some of the international relations have frayed?
Not really. Chinese people are taught for 2,000 years to travel by Confucius. His teaching is it is better to travel 2,000 miles than to read 10,000 books. So parents always want to use travel as a means to educate their children. When you're traveling, you're not only learning theories, you are working with the people along the way. So Chinese people enjoy traveling.
Well, I'm just curious to see how this pairs with some of what we see in the economic data and some of what we're seeing out of even official rhetoric that just demand is not there. You look at loan demand falling off a cliff regardless of rates that have been falling pretty significantly. You talk about the potential for some sort of further stimulus. Where's the disconnect in all of the demand that you're seeing on your site and what we're hearing about from all of the other indicators?
Yeah, because China is very big, we need to look at different segments. Certain segments have pressure. For example, real estate might have some pressure. However, if people are not buying houses, their disposable income is increasing. So the segments that's doing very well, travel is doing very well, entertainment is doing very well. For example, concerts, music festivals, opera, these are doing very well. Wellness products are doing very well. So really depending on the segments.
You mentioned how it's difficult for Chinese consumers and citizens sometimes because the bureaucracy of visas to go, say, to Europe or the United States. Where are Chinese tourists going? What are the top destinations?
There are certain regions doing very well. For example, the GCC countries in the Middle East, they offer free visa They doubled the flight capacity, so we're bringing double, triple volume into the region. Thailand does very well. The Prime Minister just offered 5 months free visa. He personally went to the airport, roll out red carpet to welcome Chinese tourists. Singapore does very well. So whoever grasps the opportunity, give free visa, double the air capacity, will do very well. And China, on the other hand, also extending their welcome to the rest of the world. The first batch, we issued free visa for 6 countries: France, Germany, Italy, Spain, Netherlands, and Malaysia. And then this week, we added 2 more countries, Switzerland and Ireland. And Singapore and Malaysia and also Thailand are going to have mutual free visa. All these actions will promote bilateral travel.
Chinese consumers are also paramount to the luxury industry.
Correct.
Do you find consumers are now more interested in travel and an experience or going after some luxury goods?
I think China is very big. Out of 1.4 billion people, you will find all kinds of customers. The most expensive tour, Trip.com, sale costs about 200,000 USD per person per trip, 80 days around the world. And it only took us 17 seconds to sell these packages. So yeah, we do have, very affluent population, and also there are young people wants to have good experience, listen to a concert, attending music festivals. So you can find different categories.
Jane, you went through a range of countries. You listed them. There was one I didn't hear. I didn't hear you talk much about the United States of America. I understand it's difficult for you to talk about politics, being a Chinese company, being the CEO of one. I'll talk about the politics briefly, and you can kind of walk me through the consequences you might be seeing. Clearly, there's no love lost right now between the United States and China. It's a difficult relationship, has been a difficult relationship for the President of the United States right now, Joe Biden, and previously with Donald Trump. Has that led to less travel? What do you see? Are Chinese tourists traveling to the United States like they were before the pandemic?
From our data, USA still is the top 3 travel destination.
Still right up there.
Very top there. People want to travel there. It's just the visa situation and the flight capacity are holding back. So I'm hopeful in the new year we'll do better.
Are prices going up? How expensive is it to travel between the United States and China?
Exactly. Price, as you can see, particularly in a major city, London, New York, becomes very expensive. But people have been longing for travel after 3 years of the lockdown. So I think they're ready.
We were talking about how there's the biggest delegation from China here on an official stature since 2017. But you were mentioning there aren't that many business members that are here from China. Why do you think that is?
I think this is the first year without, all the control measures. Gradually, I believe more and more people will come and attend these meetings.
So you don't think it's because there isn't necessarily the interest or a desire for the investment from overseas?
Not really. I think particularly during this time, we should stay engaged and really let people know what's going on in China. And the government is taking a giant step to welcome friends from all over the world to visit China. So I hope you can all come.
You'll have to arrange the trip for us.
Absolutely.
Well, based on what you've said about prices from America to China, we want a discount, okay? I need like a major discount. Jane, thank you. Jane Soon there of Trip.com. Jane, appreciate your time. Thank you very much. China's largest online travel platform. Just some insight there, Lisa, into what's going on domestically and what's happening with international travel.
I thought that the point about visas is fascinating.
Oh, it's massive. It's a huge issue.
The idea that people can't get visas and that some places, like the Middle East, are saying, hey, come on down, come buy all of our luxury products, and we're going to make it super easy for you.
Well, that's the exact point that you hear from Mohammed bin Salman and some of these leaders. They want to not just have an economy that's embedded with fossil fuels. They want to become tourist destinations.
Coming up on this programme, we're going to catch up with Ishwar Prasad, the Professor of Trade Policy at Cornell University. That conversation is just around the corner. We'll talk about international trade, fold in some international politics, get to the economy. He thinks maybe the mood is too gloomy. Maybe we should be a little bit more upbeat on the global economy.
I mean, honestly, we've been as upbeat as I could possibly imagine. It's making me slightly ill.
Well, you,
so,
relative to how we usually are.
Well, you've been holding down the fort with some gloom, trying to bring in some skepticism around artificial intelligence. But to me, what I find fascinating is, on one hand, you've got all these policymakers talking about how trade is coming apart, and then you have business people like Qualcomm CEO coming out saying that they're actually increasing their business in China China, and that the businesses are looking cross borders just like they always have. Where is the opportunity? That is really the main story I've taken away.
Without a doubt. One more hour still to go. Looking forward to that next hour on Bloomberg Surveillance. Going into it, counting it down to the opening bell, with equity futures on the S&P 500 slightly elevated by 0.4%, up by 0.4% this afternoon. This morning in New York, in the equity market pushing higher, yields pushing lower in the bond market, down by about 2 basis points, 4.08%. This is Bloomberg.
You're going to have more volatility going forward. Returns are likely going to be lower in the next decade.
At this particular moment in the markets, tail risk is higher.
I have no idea how to interpret the market. It seems very sanguine.
Right now, particularly ending the year with the melt-up, there's just too much broad optimism.
We think earnings are growing. The street thinks 11%. We think half.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
It is day 3 here in Davos, Switzerland at the World Economic Forum. It is hour 3 for Bloomberg Surveillance. Good afternoon for our audience worldwide, live on Bloomberg TV alongside Lisa Abramowicz. I'm Jonathan Ferro, together for the week with Bloomberg's Annmarie Hordern. And your equity market attempted to bounce on the S&P 500 by something like 0.3, 0.4% after 2 days of losses. Here in Davos, Switzerland, on the economy, I'd say things a little constructive. I wouldn't say upbeat, but better than downbeat. On the geopolitics, absolutely dire. And Lisa, that's been a story of the week so far.
Especially with armies of police officers marching around. I really do think that sort of adds to the tension, this idea that there are these officials that would be massive targets, whether you're talking about the Ukrainian president, whether you talk about the president of Israel, whether you talk about the Iranian foreign minister. So that kind of keeps this cloud over all the optimism we keep hearing.
Yeah, there's also a sniper behind your head, Lisa, not to mention that. I think sometimes our viewers see it. But for me, this is much more than a business conference. And the cloud over the business community right now is geopolitics, whether it's emanating from Washington, D.C., about who's going to be the next president of the United States, or the global input cost to do business when you have the Houthi rebels basically taking control of the Gulf of Aden and the Red Sea.
That final point is the point. The inability of the West, the United States, together with the UK, with strikes in the Red Sea on Houthi rebels over the last week or so, the inability of them to restore order in the Red Sea. The very fact that the Houthi rebels have been able to disrupt commerce in the way that they have done, the very fact that even with strikes from the United States and the UK, in the United Kingdom, we've seen this, what now, twice? Twice in the last week or so, Bramo, and yet still we haven't been able to restore order.
Which is the reason why there is a lot of gloom around trade in particular. How does trade sort of revive with these tensions between countries, but also the freedom of the seas being fundamentally challenged? Because if the Houthis if they're gonna get away with this, why wouldn't other groups do the same thing? It's a very low impact way to really disrupt a whole lot.
There's a lot to talk about. Let's get to the financial markets first, and the equity market on the S&P 500. We are bouncing back by, let's call it 0.3, 0.4% higher. Yields are just a little bit lower on a 10-year at 4.09%. We have caught up with a ton of people in the financial service industry. Take a listen to what the bankers have got to say.
I must say 2024 is starting off from a banking perspective quite well.
We feel quite strong in 2024 as all of those investments are going to deliver for us later. But the direction of travel is the same. Clients are still there.
The regulatory environment's really uncertain in the U.S. The rules around liquidity, the rules around capital, the Basel III endgame.
Regulators are looking in the wrong place, looking to over-regulate the banks.
It's going to be a bumpy year, but more than anything else, we've got to be resilient. We've got to be prepared to react to news.
I'm very much concerned about the small and mid-sized banks. They've got several risks happening at this point in time.
There's always concerns, but today the regional banks are stronger.
It's all about banking over the next few hours on Bloomberg Surveillance. Bramo, 2 big conversations coming up a little bit later.
We are so looking forward to having Morgan Stanley's Ted Pick, the new chief executive officer, who's going to join us shortly. And then, of course, Bank of America's Brian Moynihan on some of these questions around some regulations, capital requirements, and the competitive edge with the growing private markets that we keep hearing about.
Yeah, the mood of maybe the bankers on those capital rules downbeat. Our next guest thinks we should be a little bit more upbeat, perhaps, on certain issues. Ishwar Prasad joins us now, the Professor of Trade Policy at Cornell University and former China IMF head, joins us now. Good afternoon, sir.
Good afternoon.
Professor, why do you think we should be in a better mood?
Well, maybe it's not time for celebration, John, but certainly there is some reason for optimism. If you look at inflation around the world, it's on a downward glide path. The largest economy in the world, the U.S., is doing pretty well, all things considered. China is certainly not stable yet, but most of the indicators are coming in relatively positive, and it looks like they can sustain decent growth momentum over the next year. India is doing well. Certainly the Eurozone is very downbeat, but overall, as you look at the global macroeconomic position, it doesn't look too bad. Not great, but not too bad.
Engines for growth. Ken Rogoff, Harvard, sat in your chair just 3 days ago. He was much more downbeat when it comes to engines for growth. What is the engine for growth in the global economy this year?
That's going to be difficult. If you think about the two largest economies, they're doing reasonably well, and certainly there is a question about how much we can count on U.S. consumers to continue stepping up to the plate. Chinese consumers are trying to do so, as your previous guest indicated, but whether they'll really pull in global demand remains open to be seen. One of the interesting issues here is whether all of this promise that productivity gains might come from the new technologies might actually start showing up soon is a potential growth driver. We've already seen some indicators in the U.S. data, and it's possible that we'll start seeing this in the data more broadly. But of course, the cloud hanging over all of this, as you said, is really dampening the mood in terms of where the economies might be going.
There's also a feeling that it's not just deglobalization. It's the U.S. separating itself from the rest of the world and putting up these hurdles, whether it comes in tariffs or other types of measures. I'm really struck by the number of executives who've come on and said, you know, Biden isn't that different than Trump when it comes to some of the tariffs and some of the other policies. So how much does that put a damper on international trade, particularly with the U.S., at a time, even with the uncertainty of the election, regardless of who wins?
The uncertainty is really the crucial issue, because it's clear that we're not going to move to a stage of dampened conflict. If anything, conflict gets worse, and the best case scenario is that things don't get worse, especially between the U.S. and China. And that's not a very good environment to do business in, because you know that the economic policies are going to be largely driven by the political cycle, and there is this broader theme of decoupling, de-risking between the economies, and how that translates into policies is never entirely clear to businesses, so they hold back on investment, which ultimately ends up hurting growth and possibly even productivity growth.
Have you ever seen a wider divergence between business executives that are planning out trade routes and that plan to lean into the globalization as much as they are, and populations that are leaning against it, and the politicians who represent them leaning against it and talking about nationalism more and more?
Yeah, the narrative that globalization has not worked well for everybody, especially the economically underprivileged, that has certainly taken hold. And if you layer on top of that national security considerations, then it becomes a very potent mix that's very difficult to get around from a policy perspective. So the narrative that we need to protect ourselves, that we need to make sure that we can insure ourselves against geopolitical risks, let alone all the other risks out there, that's a very compelling narrative, and it causes an inward-looking turn to policies. And that ultimately is not good for the world economy, and especially not for businesses, which explains why you're hearing these negative sentiments from businesses.
The concern amongst a lot of Europeans at Davos has been the return of Trump to the White House. Can we talk about the policy, given your expertise is in trade, of what his 10% tariff wall would actually mean, not just for inflation in the United States, but also American companies that want to do business abroad into foreign markets?
America has been the trendsetter for globalization, for opening up, for free markets and so on. And a pullback from that, I think, has very important implications for how this narrative plays out in the rest of the world. If America starts putting up walls, that is going to mean that other countries will find it much easier to start putting in place restrictions of their own. And that could certainly lead to a disruption in trade. Now, having said that, businesses understand very well that even if you don't take advantage of the full spectrum of globalization, having regional supply chains, even in North America, for instance, can be very beneficial. So we might see a splintering of trade, even if not a complete pullback from trade. But certainly it is going to add to costs in addition to the uncertainty, and that's not good for inflation, it's not good for economic progress, and ultimately it's not going to be good for growth.
If we were to see that, though, who wins? What countries win in that environment? Does China win?
I don't think anybody really wins. The question is who loses less, because ultimately I think globalization has worked reasonably well. Again, in certain parts of the world it's not worked well for certain segments of the population, but that's largely because of domestic policies. I think if the rules of the game are set that everybody plays on a level playing field, then in fact the gains can be very broadly distributed. Even if you think about the U.S. China relationship, that really has been seen as a positive-sum game. There are some countries that might benefit from geopolitical splintering. If you think about a country like India, it's right in the middle of different geopolitical alliances, so it could end up getting some of the benefits from this reshoring or friendshoring. But by and large, it's a net negative for all countries, I think.
Ishwar, can we talk about trade policy, theory, meeting practice? We were all taught at school, at college, that increased trade, increased interdependence between countries leads to peace. Isn't Russia a fantastic example of the last 2 years that just disproves some of that? How do you fit in what's happened in reality over the last couple of years to the theory that we were all taught over the last few decades?
No, that was the assumption that economic progress would lead to a movement towards, liberal democracies, because that was seen as the epitome of, the structure of economies, societies, and indeed civilizations. And I think that has come under deep question. I mean, the notion that democracies will be self-correcting, that has really been put to the test in the U.S. in the last few years and will again be put to the test in just a few months. So I think it has caused a disillusionment among those liberal values. And of course, now you have a very important player in the world economy, China. There is a very different set of values if you think about economic organization, societal organization, political organization, and they want to push that. And there are certain countries and leaders of those countries that find that view very compelling because it allows them to maintain their power. So I think we are seeing a conflict not just in terms of trade policies, but really a much broader conflict in terms of these fundamental values.
We're coming through history here, so it's not particularly helpful, but I do want your opinion on this. Do you think it was the arrogance of the West to believe that China would ultimately want to become more like us as they did more trade with us and became wealthier? Is that what the misplaced view was all those decades ago? That is proving to be misplaced. I mean, it seemed like a reasonable view that once people had their basic necessities met, that they would aspire to higher values, the freedom of expression, the freedom of association, and so on. And that doesn't seem to be happening. People seem to be perfectly willing to trade off those liberties for economic progress. And unfortunately, that is something that we had not quite anticipated.
We also didn't quite anticipate why there wouldn't be some sort of interference with the policies of Xi Jinping that have really hampered the economy, why there wouldn't be more kind of measures taken to really invite in foreign direct investment that we've seen actually turn negative for the first time in decades. Have you gotten any answers to that from the delegation from China about whether they actually are committed to bringing international business investment into the country with some stability in their policies?
So Li Chang, the Premier Li Chang's speech a couple of days ago and my meetings with the Chinese delegation members have all sent a very uniform message, or what they're trying to send a message to the world is that basically China is on the right track in terms of its economy. There are some risks out there that can be managed, and China remains open and welcoming to foreign investors and businesses. Foreign investors and businesses don't see it that way. They see a much more hostile environment because it's not just the macroeconomic situation that has changed, the regulatory environment has tightened, plus the political environment has tightened. So it's going to be very difficult for China to market this message that it remains open, that it should be a place that foreign investors and businesses should look to.
This finished gloomy, but to be fair, we took it there, not you. We should be happier. The mood should be better, apparently. Ishwar Prasad of Cornell. Thank you, sir. Professor, it's good to catch up.
My pleasure.
Turns out that we can make anyone gloomy, even people who are the most optimistic.
Bramo's back. For those of you that missed the first 2 hours of this program, Lisa was like just overjoyed, constructive. I'm not sure what Happy Valley did to her, but ultimately the gloom and doom of Bramo just sort of drained away.
Believe me,
too many Davos parties.
Okay, hold up. First of all, no. Second of all, I think that there is this feeling that I am listening to what people are saying, and if you take them on their face,
and we're
they're
not listening.
Optimistic. I'm not saying that you're not listening. I'm just saying you have to take that into account. There is a lot of gloom out there. Believe me, I'm the same me.
You haven't changed.
I haven't changed. It's just that there is a lot of reason to think that there could be some sense of, economic advancement with
Never
all
change.
Of these
no one
people.
wants you to change.
Don't
all right?
worry, I won't.
Don't change.
Let's move on.
Coming up on the programme, James Quincy, CEO of Coca-Cola. Big question. Bramo wants to know, your biggest competitor right now, Pepsi or Novo Nordisk? That question up next. Two Brits in a studio, just to level things out, just a bit of balance. It's what we like to see. We'll get to the second Brit in just a moment. In your equity market on the S&P 500, here's your update. We're higher on the S&P 500, up by around about 1/3 of 1%, up by 0.4 of 1% now. Yields coming in by a single basis point, down on the 10-year to almost 4.1% on a US 10-year yield. Let's get straight to it. It's fantastic to catch up with James Quincey, the Chairman and CEO of Coca-Cola. Good afternoon, James.
Thank you.
It's good to see you again. Just fantastic to catch up. We gave away the first question before the commercial break. I don't know if you heard it or not. If you didn't, it's
no, I heard you laughing, but I didn't hear the question.
Well, here comes the question. All right. Lisa wants to know this, not me. I'm not interested at all. Biggest competitor right now. Is it Pepsi or is it Novo Nordisk?
No, definitely Pepsi. Actually, the beverage industry depends on where you are in the world. Because we're so global, we actually face a number of kind of multinational and regional competitors around the world. I think the drugs is something that certain segments of the financial community got super focused on, the GLP-1s, but when you actually break down the data, I don't think it's a big thing for us. And in the end of the day, if you want to make it super simple, we sell a whole range of beverages from calories to 0 calories. And at the end of the day, you could eat less calories if you want to lose weight. You can't have less liquid.
Let's talk about the product mix then, whether that changes. We know the stats, about 40% of Americans are obese. If these GLP-1 drugs really, really kick on, if this is like the big solution to a monster problem in the United States of America, do you have to change the product mix? Do things start to shift at Coca-Cola?
Well, the product mix has been shifting over time already as people have tried to balance out the calories with the drinks they love. The 0 calories have just continued to grow steadily over the last couple of decades. So I think it'll just be another piece of the puzzle. As calories come under control, we'll see more 0 sugars. But at the end of the day, people will still enjoy an original Coke every now and again. Well, that's not going to go away.
I am curious, though, who is your main competitor?
Who is our main competitor? Actually, we face a range of competitors.
Yeah, which is number one person who you wake up every morning and you look and try to see, what is that guy doing?
No, that's not how I wake up in the morning.
How do you wake up in the morning?
Because if I just chase my competitors, I don't do something new. I've got to chase my consumers. I need to think about what the competitors are up to. They're very creative and there's some very talented people. But in the end, I'm trying to satisfy the consumer. And so if I focus on the person who's drinking the drink, what would really make them happy, what would make the retailer happy, then I will outpace the competitors.
So how much are consumers willing to pay for caffeinated artisanal water? I mean, at a certain point, are you seeing that you're able to charge what everyone? I don't know, I just wonder, whatever it is that's popular for consumers in different segments. But I'm wondering, do you see your pricing power so much stronger now than before the pandemic?
Our focus has always been to earn our pricing. We don't think about pricing as a markup versus the commodity price. So it's about earning the pricing, whether that's the marketing, the innovation, different package sizes, different formulas, different products. It's really about earning the pricing, because unearned pricing is a catastrophe about to happen.
Back in October, you raised your outlook despite challenges in China. Are the tailwinds back then proving to be more durable, and are the headwinds starting to fade?
Look, we're in the closed period ahead of earnings, so no comments on that.
Just a sneak peek.
Just a sneak peek. Look, one thing I tried to say last year was there are always going to be headwinds. Sometimes they're economic, sometimes they're wars, sometimes, in the case of the last few years, pandemics. One of the things we have underlined is we have an all-weather strategy. Things are going to happen. There are going to be headwinds. There were headwinds in 23. There were headwinds in the years before. Something will be a headwind in this year. But we are focused on our all-weather strategy to see it through, to manage through it, and deliver for the consumers all the way through to the shareholders.
I understand you can't speak specifically to numbers, so I won't push too hard. I do want to know about China, though. It's been really hard to get a read on what's happening in the world's second largest economy. We spoke to someone who looks at tourism in China, the biggest online tourism platform, trip platform for China, just a moment ago. And she said things with the Chinese consumer are pretty decent, things are picking up again. I hear all the time, we all do, that consumer confidence there has just been shot given the pandemic and the extended lockdown. What's your feel on that? Have things improved on the ground in China?
Things are improving in China, and a bit like when the openings happened in the US and Europe, different sectors moved at different speeds. So you do get a bit of weird noise, or weird interpretation could be out of China, because it depends which sector you're talking to. From our point of view, Chinese New Year is a very big thing for us. It's effectively their Christmas, and it happens, in the first few weeks of the year. So actually trying to gauge what's happening is very difficult for consumer businesses until Chinese New Year finishes, which will basically be the end of February. So that's for us, the real test is where do we stand post-Chinese New Year? And I think one has to gauge the numbers you're getting depending on which sector you're talking to. And obviously the Chinese government's very focused on managing the property sector, but also keeping the consumption alive.
I want to go back to how John began the interview with respect to Novo Nordisk or Pepsi. And I do want to sit on Ozempic for a second, because we hear all of these analysts talking about how much that's going to decrease demand for certain goods. Have you already changed your product mix? Because you said that that's how you would respond to this. Have you already changed your product mix in anticipation of a lack of demand in certain areas?
We already have the products.
What are the products?
We have already been working towards giving people choice in the face of a need to reduce the amount of calories, whether it's in the US or other countries in the world. Almost every brand we have a low or no calorie option available for it. So it doesn't matter how you want to take your balance of calories, we have an option for you. And so over time, yes, the total mix has been shifting a little bit to the low and the low and the no calorie products, but the products already exist.
So how much do you expect the traditional Coca-Cola brand to be a much smaller part of your overall business, say, in 10 years?
We see the Coca-Cola brand including all the variants.
Okay, I know.
The original, the zero.
Coca-Cola Coke that everybody gets, the original from the 1960s commercials.
I think it will still continue to be a big part of the business.
There's a really delicate moment happening now, and it's being talked about a lot on the sidelines of this conference with Israel's president here, of course. How are you navigating the Gaza war, given the fact that Turkish Airlines just got rid of Coke on their flights?
Look, there's a lot of tragedy happening there. There's a lot of people getting here. We have an Israeli bottler. We have a Gaza bottler. The employees on both sides have been killed, wounded, family members. So it's a very painful moment at the moment. Our focus has been on supporting our employees, in supporting those with losses, and really trying to look after the people who make our business decisions happen.
So is it incorrect when Turkish Airlines comes out and says they're getting rid of Coke because Coca-Cola supports Israel only?
Look, I'm not going to get into one specific situation, but look, we have, let me give the simple example. We have an Israeli bottler and we have a bottler in the Gaza Strip. And so we're very much in the business of being in every country. Obviously, people who buy our products get to make their own decisions. And at the moment, we're very focused on the humanitarian issues that this has thrown up.
Let's broaden that out just a little bit, James. There's a reason that you have a bottler there and a bottler in another place. You've got experience of this for decades now. Is it getting harder to do business everywhere, given what's happening? All of the questions we see at a forum like this one, James, as you know, lots of questions about geopolitics. As Lisa talked about earlier in the hour, hot wars, not just in Gaza, but in Ukraine as well. Is it harder being everywhere than, say, maybe 10 years ago?
I don't think so, because in the end, every political leadership of every society wants to deliver jobs on the ground and an improvement in quality of life. And the great thing about the Coke business is it's an incredibly local business. All the countries in country A are made there, and all the Cokes in country B are made there. It's a truly local business, and jobs, prosperity, and a better life is what virtually every government on the planet is trying to deliver for their people.
James,
So
this was great. This is fantastic. It's just great to catch up with you, but always is. I've just got one final question. My producer, Amy, has Diet Coke for breakfast. I've got issues with that. Do you think that's OK?
Why are you trying to tell her what her choices are?
Diet Coke for breakfast.
What did you think he would say?
Diet Coke for breakfast, just Diet Coke for breakfast.
Diet Coke is making a comeback, I think.
It's not.
Did you not see the Saturday Night Live?
Is it coming back? Is it coming back?
Look, it's a great product. It really
What
is.
did you expect him to say? You just basically tried to throw a bone to Amy? Good job.
Trying to convert Amy to, just water to start the day.
This is a good one.
No, I know. James Quincy, Chairman, CEO of Coca-Cola. James, it's good to see you. Thank you, sir. Thank you very much. Coming up on this programme, Ted Pick, the Morgan Stanley CEO, is just around the corner. That conversation is coming up very, very shortly. Taking a helm of Morgan Stanley only, 2 weeks ago?
Yeah, something like that.
2 weeks
Turn
ago.
of the year, yeah.
January 1. We want to know what happens on day one. You take over the bank, James Gorman gets kicked out of his office.
Put your pictures up,
you put your photos out.
Up.
You get one of those boxes out for James to say thank you. Something like that. Yeah, let's see if Ted turns up. That conversation is up next. Live from Davos, Switzerland, for our audience worldwide. Good afternoon. Good afternoon. It is day 3 in Davos, Switzerland at the World Economic Forum. It is hour 3. And I'm pleased to say here on Bloomberg Surveillance, Ted Pick, the CEO of Morgan Stanley, joins us. Good afternoon, Ted.
Thrilled to be here, guys.
How are you, sir?
Great.
I did this with James Quincy of Coca-Cola. I gave away the first question before the commercial break, and I'm not sure if you heard it, so we're going to go there, and maybe you've got time to prep.
Okay.
What does day 1 look like? You know you're taking over from James Gorman. January 1, do you kick him out of the office and put the photos down? How does it work?
Well, first of all, James is still the boss. And it's a great question. You remember that Robert Redford movie, The Candidate?
Go on.
And he gets elected and he says, now what? There's an element of that.
That's
now
what
what?
it feels like. That's a very honest response.
That's an honest, it's like going back to school. 31 years at the firm that I love. They hired me out of college. They took me back after business school, and now I get to represent the team. It's an awe-inspiring moment. You're carrying the culture of a place that's been around for almost 90 years. And as you guys know, a place that looked at the abyss, $6.71 in October of 2008. And now here we are flourishing. And so my job is to keep going what James has done so brilliantly. And we're spending a ton of time together. It's a blast. I learned something from him literally with every interaction. And so super psyched. We've been doing these dinners together with client meetings together, and it's a real thrill for me.
You went there, you talked about 2008. I think the bank that Gorman took over from Mac back in 2010 is a very different one to the one you're inheriting today. If we can fast forward, similar time frame, another 10 years, let's talk about what you want Morgan Stanley to look like in the future. I think a lot of people have taken your recent comments as a continuity candidate at the top of the bank.
Yep.
Do you see any big changes on the horizon over the next decade or so?
What James did is he laid the seeds. He not only transformed the place, but he reclaimed the best of the culture. So my job is to take the moats that have been built through transformation in wealth and asset management, where, as you know, we have about $6.5 trillion of assets under management, and a world-class investment bank. Pretty tough to compete as a global investment bank now. There are only 3 or 4 of those wealth managers, only 3 or 4 of those global investment banks. And he reclaimed that culture, and now to press on integrating the two. One ecosystem. Individual is now a walking institution. Institution now needs hedging expertise that requires certain capabilities that individuals typically wouldn't have. Sort of the migration of financial sponsors across the pockets. I think it's incredibly exciting, and we'd like to think we're differentiated from many of our competitors. We have competitors that are great wealth managers. We have competitors that are great investment banks, but to bring them both together is something special. And the reason, Jonathan, I think we can do it is really born of the experience of the financial crisis. When you make it, you either are imprisoned by that forever, or you say, we made it, let's keep the good stuff, and let's be something more. So I'm focused on integrating the firm across those 2 verticals.
You grew up in the investment bank, and yet you're really leading into the wealth management.
Yeah.
And on the earnings call, you talked about how the wealth management's in your blood, how your father-in-law and your father were both in the business. And you said this will be the engine for further Morgan Stanley growth, kind of underpinning some of your comments. Do you have a place in mind where further acquisitions will transpire in terms of the wealth management units?
Well, first, I want you to know that you've made at least one 80-year-old man very excited by met you on air. Okay, so this actually makes my day entirely.
You can name drop him. Go ahead.
Listen, I think the reality is inorganic opportunities are going to come across the transom, but the danger, and James talked about it, the danger of acquisitions, they're sort of asymmetrically against you, right? Because first, the financial proposition has to work, the business strategy has to work, and then the integration has to work. And we did it twice, right, in COVID. We did E-Trade, which I loved, because it kind of gave us enough size. It was dilutive, but that didn't matter. It gave us enough size that we're going to make it. And we saw how things can get in March, and then the aftermath in Europe. And then Eaton Vance gave us solutions. So stuff is going to come across the transom. I'm not sure we need to be in a rush because, again, we don't have sort of the victory's curse of thinking we just sort of do these things. I think there's enough organically. But I'm glad you mentioned, Lisa, because I think when you're talking about 5 or 10 years and you think about the amount of aggregation and transparency of wealth outside the U.S., particularly in Asia, we're 22% owned by our friends at Mitsubishi, who literally saved us during the financial crisis. I've been going a lot to Japan. I go every quarter. We've doubled down on Japan. Imagine, just as sort of like a vision thought, imagine wealth in Japan 5 to 10 years from now when you come off the 0 rate the zero barrier, asset allocation, wealth opportunity, investment banking. I mean, it's one example of the kind of place where we could do extraordinary business.
Does that mean that you're de-emphasizing the investment bank, that it doesn't matter as much to kind of compete head-to-head with Goldman Sachs in terms of the league tables in the same kind of way as traditionally?
Sure. What I love is that we've got a business strategy that you can do in the elevator, literally like 2 floors. Wealth and asset manager, big scale, global investment bank, big scale. And it's not actually a choice because increasingly there's synergies between the two. And I think it is absolutely important that the investment bank is agile enough that when the markets are speaking to forward volumes, early cycle behavior, which is, by the way, where I think we are now. Cross-border M&A ahead of the U.S. election. Folks wanting to deploy capital as the Fed gets going. You want to be in the core investment banking business. We had 4 years of no IPOs. The sponsor assets have gotten big. How many underwriters are going to be used to take these companies public? 6 around the world. How many people are going to be acting as advisors on cross-border large cap M&A? 2 or 3. That's high margin business. And the reason it's so important is it's the tip of the spear. It's the intellectual capital that the firm has been traditionally known for. And what is informed in part by our history of the 97 merger and then our crisis, our human capital crisis in 2005, is that the investment bank has so embraced wealth and vice versa, because what James did, this is McKinsey at his true best, is for these 14 years, he migrated people around the firm. So you have people that actually understand these businesses. Andy Saperstein, one of our co-presidents, worked in the investment bank, now running wealth and asset. Dan Simkowitz turned around our asset management business. Now he's running the investment bank. So it's not that I'm trying to sell you the story, I've been there kind of thing, and it gets people motivated, and we're motivated to hit 20% returns on tangible.
You alluded to it. We had a bank CEO earlier this week who just said it out loud. Investment banking's been in recession for the last couple of years. It's been really, really tough.
Absolutely.
I hear you communicating the end of it. Can that happen? I hate to be the guy who asks about the Federal Reserve and rate cuts. Can that end without rate cuts from the Federal Reserve? Can we end that IB recession, given what you see in the pipeline?
I hear you guys talk about this every morning. And once in a while I say, we don't know. Who knows? I think the path is probably that inflation is past. But, there's a tail. There's a 5 or 10% probability they do 50 in March. I'm not talking 25, 50, 5 to 10%, right? It's 40 to 60% they do 25 in March. There's also, if you price an exotic, 5 to 10% possibility that we have another hike in us. I kind of did that check thinking of you two guys, because it is possible that we either, because every time the Fed talks about it, right, as they did in the reverse in the teens, it tightened up and they didn't go. Now they talk about it, loosens up. It's like, okay, we don't want to have the Arthur Burns bit. We don't want it to get away from us. So we're gonna do it when we're ready. I think the big picture though is they're gonna start lowering at some point when they're ready. They're gonna be prudent. They're gonna be thoughtful. And that kind of predictability is very good for the core investment banking business, because you have these financial sponsor portfolios that have been locked up that need to be liberated. Some can go in continuation funds, some can go to other sponsors, but some have to go public or be sold. And then the corporate dynamic was folks are ready to get going then with 3 years of pandemic. There's always going to be an election, there's always going to be macro, but I think the core investment banking activity that we have known with real cost of capital, traditional corporate finance like the mid-90s, I think it's going to come back.
We've been hearing from bank executive after bank executive, it's time to start ramping up hiring. They're going to be going out there and building their teams. You doing the same thing?
We have our team. We have our team.
So no more hiring?
Well, I believe that investment banks are notoriously pro-cyclical. So we see a trend and then we'll go hire a bunch of traders or hire a bunch of bankers. If you really believe in the kind of what the culture represents, you don't want to be too herky-jerky about that, especially in the world with higher fixed compensation and longer tenures and the stickiness. Will we hire a specific banker for a specific space who wants to come onto our platform? For example, we've been hiring in Paris. We've been hiring in Tokyo. We've been picking up M&A bankers along the way. But I do like the partnership right now. I really like the team, and they're fired up to go.
There's always going to be a range of views on your stock. I'm just bringing up the stock on the Bloomberg terminal right now. I can bring up the analyst recommendation screen. Got 10 buys, 20 holds, no sells. Let's talk about one of the holds, one of the changes in the last couple of days. It came from JP Morgan. They had good things to say, but they said this: we see the excellent acquisition benefits largely discounted, see limited stock-specific catalysts in the near term. We've got to deal with analysts now and again. Some people might be saying stuff you don't like. They're neutral. It's not exactly a sell. But what would you say back to that? Limited stock-specific catalysts in the near term.
Stock had a big run. It's trading at the midpoint of the 70-100 range, trading 85-ish. Reality is that continues to be a great capital return story. We have a capital buffer. We paid a dividend. We're in 2 growth businesses. The strategy's unchanged. The James Gorman premium, it's been a real premium. And I want to make sure I have credibility with the marketplace. He did it for 14 years. I've been in for about 14 days. So I was sort of joking. He's 728 weeks, and I've done 2, so the score is 728 to 2. And then he said, but it's not that bad. It's only 3,528 trading days. So we went back and forth on that, but because he said you'd get vacation. I think the reality is that some people want to know that we get to 30% PBT margins in wealth immediately. There's always going to be that sort of knee jerk. But we were at 4.6 for Dean Witter, 8, 12, 15, 20. One of the things that James did brilliantly, as your team knows, you guys know, Sridhar knows, is he kind of always did the post and beat durably. These firms have been traditionally marked on price to book. And what we want to do, which is differentiate, is get people to look at the PE multiple, which means they can run the DCF. So that's important to me, that there's predictability and durability.
You have to go. I know that. But I do want to ask you, is it true that you can multiply any numbers whatsoever in your head in a second?
Who knows?
563 times 300.
Everyone wants to do that. I'm a rounding guy. Let's just do rounding.
All right, we'll do that.
I'm going to run the numbers after the show. Hey, Ted, it's great. We're looking forward to following the journey with you. Just fantastic. It's good to see you. Ted Pick there, the CEO of Morgan Stanley. He's got to run. I've got to check in on the market, so let's do that right now on the S&P 500. Equity futures have been positive all morning over in New York City. We had jobless claims just moments ago. Mike McKee has the data. Good morning, Mike.
Good morning, John. You might want to check that 2-year note yield because we're having quite a reaction after jobless claims come in extraordinarily low, 187,000 last week. Now, this could be a seasonal effect, but down from 203,000, it certainly has gotten the market's attention. We've seen some trimming of bets on a March rate cut from that. Housing starts disappoint, down 4.3%, but that's not as bad as the negative 8.7% that was forecast. Building permits up 1.9%. Philly Fed, interesting numbers. Negative 10.6 from a revised negative 12.8. But here's a number to keep an eye on that should catch Wall Street's attention as well. Prices paid. 11.3. It was 24.3 last month. So inflation coming down very rapidly and no change in the job market, it appears. We do have Raphael Bostic out with some headlines on the terminal today suggesting that it seems they're making progress, but he's still a higher for longer guy.
Mike McKee, thank you very much. Let's return back to that number before we take a commercial break. 187,000. Jobless claims, 187K. Pause. We start the year talking about rate cuts in March, and you just get this drip feed of data that says, what rate cuts? Started with payrolls, headline I know, beneath the surface we can have a debate. Then we've had retail sales, we've got jobless claims, you throw in the communication for the Federal Reserve. It's no cuts anytime soon, based on the early message in 2024.
And we just heard from Ted Pick of Morgan Stanley. He thinks we're early cycle, right? This is something where we're building momentum, and you get that feeling from a lot of different business executives that we've been speaking to. So at a certain point, again, it comes back to this question, can we get some sort of ongoing growth without inflation? Can we allow inflation to just gradually go down? I don't have a concrete answer to that.
The economy looking okay, looking decent. The geopolitics looking absolutely terrible. Coming up on the programme, Bloomberg's Annmarie back in the studio with us. We'll catch up with Ukraine Foreign Minister. That conversation is up next.
Everything changes if Trump wins, and mostly for bad ways. My colleagues and I, back in 2016, took Trump seriously in the sense of, we said, he stated these things, this is what he's going to do, let's model what happens to the economy. And we're undertaking that same exercise now. We're taking literally, if he puts up a 10% tariff on everything, and it's a tax increase. I mean, however you want to say it, it's a tax increase on all consumers in the U.S. And it probably increases inflation rate roughly 1.5 points.
It's a hot topic in Davos, Switzerland at the World Economic Forum on day 3. It's been a hot topic all week. The future of policy in the United States, economic policy and foreign policy. That was Adam Poston, the president of the Peterson Institute for International Economics. We can now talk about foreign policy. There are 2 hot wars taking place right now. One is in Gaza between Hamas and Israel. The other has dominated the news cycle for much of the last 2 years. It's the war in Ukraine, between Ukraine and Russia. Joining us now, I'm pleased to say, is Dmytro Kuleba, the Ukraine Foreign Minister. Minister, good afternoon.
Good to be with you.
It's good to see you. It's been a difficult time for you, your government, your country. I know you've had a series of meetings at the forum with foreign leaders. Can you tell us, just give us an indication from your conversations, how close we might be to getting that aid delivered from the United States?
Well, we received reassurances that the aid is on its way. The good news is that we see that the Congress is not debating the aid to Ukraine per se. The discussion is on the border issue, and there are no disagreements on whether and to what extent Ukraine should be helped, and this is important. So while the aid itself is not in question, the timeline is in question, and I think that today we are in a situation when the U.S. citizens are as interested in passing this law to fix the border issue as we are to fix the assistance issue.
Did Secretary Blinken or Jake Sullivan give you any indication of what that timeline would look like?
Well, I think the specificity of the moment is that it can literally happen on any day. It just depends on the moment when legislators make a deal on the border. It can happen today, tomorrow, next week, in 2 weeks' time. No one can tell you that, but we are close. As far as we understand, we are getting closer to that point.
The elephant in the room at Davos has been a return of the former president. How is Kyiv preparing for another Trump presidency?
Well, how can we prepare for anything that does not depend on us? People in America will make their choice, and we will work with that choice. President Zelensky and President Trump know each other. If he is elected, it will be a continuation of relationship, but first elections must take place. I just want to say one thing. We've been through so many things in our life, especially in the last 2 years. We are literally ready for any scenario in any part of the world.
I know you have to wait for Americans to go to the polls and make that decision, but there must be conversations happening at the high level of government in Ukraine about what would happen if Trump did become president, how that might shift your policies.
Well, we are inquiring into how the potential foreign policy team of President Trump could look like. And we're looking at these names, but I don't know, maybe we haven't worked enough, but I think it's even not certain, not obvious for U.S. analysts and people in the United States. But anyway, again, let me make this point. Whatever happens, we are ready for that. We've worked a lot with President Biden and his administration. They did a great job helping us, and we will always be grateful to the people of America and to the Congress, to the Biden administration, for helping us to survive in the most difficult times. But I'm absolutely confident that irrespective of what will be the name of the next president of the United States, the victory of Ukraine will be in the best interests of America and American people.
Minister, we've seen President Zelensky meeting with a lot of bank executives, trying to drum up support. Have there been any meetings with any of the Chinese policymakers who have been here at Davos?
No, because President Zelensky speaks with President Xi. And there were 2 phone calls between them, one before the war and another one after the large-scale invasion began. This is the line of contact that they are upholding. And we have our Prime Minister, and we have nothing against Chinese Prime Minister and Ukrainian Prime Minister speaking to each other. But we are now working on organizing another call between leaders of China and Ukraine, because there are things that they can talk about, namely peace formula proposed by President Zelensky as a way to restore just and lasting peace in Ukraine.
How are the business leaders in places like the United States, Jamie Dimon, for example, instrumental for Ukraine right now?
Well, President had 2 excellent sessions with business leaders, and I think this is the added value of Davos. You cannot do skiing, but you can do business skiing with the business leaders who gather all here, at Davos. And I was impressed with very positive atmosphere. It's very different from what you read in the news and in different expert comments published widely. Business is very focused on helping Ukraine. Business believes in Ukraine. And business is focused on finding solution instead of just endlessly discussing problems.
What we see in America with this stalled money, we also see American consumers worried about inflation. And there are questions, why is this money being sent abroad? At the same time, there's reports of Putin putting out feelers, their intermediaries, potentially wanting to sow this doubt that potentially the U.S. would do some sort of agreement with Russia and try to get Ukraine to the table. What do you make of that? Have you discussed these reports with your counterparts in the United States?
Well, first, Ukraine does not steal any money from American taxpayers. If you compare the overall budget, even just the defense spending of the United States and the sum of money allocated to Ukraine, it's, to say the least, a very little part of the overall defense spendings. Moreover, a vast amount of this money stays in the United States because it's invested in the production of weapons that goes then to Ukraine, and it needs to be explained to American taxpayers that their communities benefit from it, their new jobs are created. Second, everyone should understand one simple fact. Whatever the price of supporting Ukraine today is, the price of fixing the mess in the world, if Ukraine loses, will be much, much higher. And most importantly, Ukraine is probably the first country in the world that is fighting a war against another country, has United States as an ally, and is not asking American troops on the ground. So you save the most important, you save few lives of your soldiers. So we kind of offer the best deal on global market of security. Give us the weapons, give us the money, and we will finish the job.
2022, excuse me, was all about coalescing around Ukraine, all hands on deck. 2023 was this counteroffensive. It didn't really go as planned. What is 2024 about in Ukraine? What is the plan this year?
2024 will be about throwing Russia from the air, because the one who dominates the air defines the timeline of the war and the terms of peace. It will be about filling the front line with drones and other sophisticated technology, because the counteroffensive that you mentioned taught us an important lesson, how war changed and how drones and software and artificial intelligence become the real kind of masterminds of warfare. 2024 will also be about keeping the Black Sea under Ukrainian control, because we achieved a major victory on the Black Sea last year when we made the the invincible Russian Black Sea fleet flee Crimea and hide on the eastern side of the Black Sea, and that allowed us to restore our exports. And food prices in the world are under control. Ukrainian economy has like a fresh breath because export is finally working. So this is all very important thing. And of course, another goal for 2024 is frozen assets, Russian frozen assets. They must become available for Ukraine.
That's highly controversial. Why do you think that's the case? Rule of law is tremendously important. Do you not think there's a risk around establishing a precedent on that issue?
Well, first, how much bankers and lawyers in the West were thinking about rule of law, harboring dirty money of Russian oligarchs, laundering them and helping them out. Second, to what extent Russian money should be protected by Western rules, as long as Russia attacked Western rules and wants to destroy them and to build a world that will know no rule of law. Yeah. And third, guys, you have far better experience in business. When politicians make a will, make a decision, bankers and lawyers find solutions. We can engage in an endless discussion about immunities and legal repercussions, but the solution is there. We just need to make it.
Minister, thank you for your time. We appreciate it. The Foreign Minister of Ukraine, Dmytro Kuleba. From Davos, Switzerland to the World Economic Forum, this was Bloomberg Surveillance.